Hello everyone. I hope I'm clearly audible and visible to all of you. And I request everyone to join this particular session. And this session is going to be very, very important for all of you for the RBI Grade B 2026 examination. For the phase 1, for the phase 2, this session is going to be very relevant as the RBI has released its annual report for the 2025-26. And this report is very important report of the Reserve Bank of India from which we have seen questions in the phase 1 in the previous years. Okay. So this session is going to be important and give me a thumbs up if I'm clearly audible and visible. Support team was facing some issue. That's why the session took a little more time to start, but I hope now I'm clearly audible and visible. Chalo. So this session is going to be important that I have told you, and let's start with the annual report of the RBI 2025-26, which is a very, very, very important report of RBI. Now, before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos and join our Telegram channel where you will get the PDF of the session. So the link for the Telegram channel is provided in the description box below, and you will get the PDF of the session in the Telegram channel of EduTap. Okay. So now we are going to start with the annual report. See, the RBI, the Reserve Bank of India, released its annual report for the 2025-26. This is a statutory report of the Reserve Bank of India. That means this is the legal obligation of the Reserve Bank of India to release this report. So the RBI has released the annual report for 2025-26. This is a statutory report of its Central Board of Directors of the Reserve Bank of India. The report covers the working and functions of the Reserve Bank of India for the period of April 2025 to March 2026. That is for the previous financial year 2025-26. The working and functions of the Reserve Bank of India have been summarized in this annual report, have been laid down in this annual report for 2025-26. Okay. So first of all, this is the idea of the annual report, that why it is released, and it is released in May every year for the previous financial year. Okay, so May every year for the previous financial year, this annual report is released by the Reserve Bank of India, showing the working and the functions of the Reserve Bank of India in the previous financial year. I have brought for you the important points from this annual report from where the questions can come in the examination. Okay, now this annual report is divided into 12 chapters. This annual report is divided into 12 chapters and two parts. So first part is the economy review and prospects. The most important data points are laid down in this part 1, the economy review and prospect. This provides you the assessment and the prospects and the economic review. Okay, so we will discuss this part 1 and then we will move forward with the part 2 that consists of the working and operations of the Reserve Bank of India. So in the previous financial year, the initiatives that have been taken by the Reserve Bank of India, the functions of the Reserve Bank of India, they are provided under these chapters. Okay, so part 1 consists of the data points regarding the economy, the agriculture services, the external sector. So the data point is provided for the economy, for the different sectors of the economy, for the inflation, for the economic growth. The data point is provided in this part 1. The part 2 consists of the working and the functions of the Reserve Bank of India. Okay, that what initiatives have been taken by the Reserve Bank of India, all the important data points and the changes that has been made by the Reserve Bank of India in the previous financial year, it is summarized here. So this is what we are going to do. The 12 chapters are present in this annual report in two parts. So let's get started with the first part. Give me a thumbs up, give me a fire sign if everyone is ready for the part 1, if everyone is ready for this annual report. Okay, and I have summarized, I have brought the important points so that you can focus on these points from the examination perspective. Chalo, let's start with the part 1, that is the economy review and prospects. So we are starting with the first part first. Okay, assessment and prospects of the global economy. See, in the assessment and prospects, first we have to discuss about the global economy, then we will come to the domestic economy. So this is how it has been given in the annual report. First the global economy assessment and prospects have been discussed, and then for the domestic economy. Okay, so in 2025, the global economy displayed resilience with 3.4% of growth. So the growth rate of the global economy was 3.4% in the 2025. Now this was higher than the growth rate of the global economy in 2024. The growth rate of the global economy was 3.3% in 2024, which has increased to 3.4% in 2025. The data has been taken in the annual report from the IMF World Economic Outlook April 2026 edition. Okay, so this is from where the RBI annual report has taken the data. So in 2025, the global economy displayed resilience with 3.4% of growth in the global economy, but this growth is still lower than the average. This growth is still lower than the average of the global economy. So we'll discuss the average. The average is 3.7%. This was the growth rate, the average growth rate in the period of 2000 to 2019, in the period, in this time period. Okay, or we will discuss the time period. So basically, the average growth rate of the global economy is around 3.7% in the previous decades, but recently, because of various problems, because of the high tariffs, because of the elevated trade related uncertainty, rising public debt, geopolitical tensions, because of all these factors, the growth rate has been lower in the recent years. But still, we can say that there is improvement from 2024 to 2025. There is the improvement in the growth rate for the global economy, which has increased from 3.3% to 3.4%. But still, the growth rate of the global economy is below its average growth rate, the decadal growth rate. Okay, now, why there is the improvement from 3.3% to 3.4%? The improvement, even with the high tariffs, even with the elevated trade related uncertainty, even with the rising public debt and geopolitical tensions, there is the improvement in the growth rate of the global economy because of the front loading of imports. What is the front loading of imports? See, right now, it was announced that the tariff is 25%. The US announced, let's say, the tariff is going to be 25% on the Indian exporters on these particular industries. Now, the Indian exporters know that in the future, in the coming months, the tariffs can be increased. So, Indian exporters started exporting more right now with 25% of the tariffs because they were afraid that in the coming period, the tariffs can increase to 50% or 100%. So, there was front loading of imports that were happening. There was front loading that was happening. Okay? Front loading means load the product before the tariffs further increase. So because of the front loading of imports for the certain time period, the trade increased. Fiscal and monetary support was provided in the global economy. Like different countries were providing, the advanced economies, the emerging economies, they were providing the fiscal and monetary support. Okay? The government support and the support by the monetary authorities were provided for their own economies. Supply chain realignments happened. A surge in artificial intelligence related investment. So investment in technology improved. Due to all these factors, the global economy improved from 3.3% of the growth rate to 3.4% of the growth rate. Global financial conditions remained broadly accommodative. Just remove the April and May 2025 because of the tariff tensions. Other than these 2 months, for the other months, there was the global financial conditions that were quite uh, accommodative. Okay, so this is the idea. Now, the outlook, as I've told you, that for the period of 2000 to 2019, for this time period, the average global growth rate was 3.7%. Remember this, that the average global growth rate was 3.7%. And till now, in 2025 also, in 2024 also, we are not able to meet the global average growth rate. The global economy is not able to meet the global average growth rate that was achieved in the period of 2000 to 2019. Okay, so this is what you have to remember, that in the period of 2000 to 2019, the long term average was 3.7%. Still, like the in 2025, the growth rate has improved from 3.3% to 3.4%, but still we are below the global economy. Growth rate is below the global average. Okay, so the outlook for the global economy, the outlook now for the next year, that is for 2026. Here you can see what is the outlook for the next year. The outlook for the global economy in 2026, moderate expansion, shows moderate expansion of 3.1%. So global economy is going to grow. It is expected, it is projected that the global economy is going to grow by 3.1% in 2026. This is a very, very important data point. Okay, so now why it is expected that next year there will be lower global economic growth because of the geopolitical risk, which has re-emerged as the dominant drag on the global growth in 2026. So because of this West Asia crisis that started in the end February 2026, so there is the adverse impact of the outbreak of the conflict in the West Asia in the end of February 2026, and with this the forecast have turned downwards. The global economy is projected to grow by 3.1% in 2026, which is lower than the 3.3% of 2024, which is lower than the 3.4% of 2025. Okay. Now, it was expected in January 2026 when the forecasts were released, it was expected that in 2026, the global economy is going to grow by 3.3%. But now in April 2026 forecast, it has been shown that because of the geopolitical risk which has re-emerged, the global economy growth prospects are now 3.1% for 2026. Any confusion? Clear? Chalo. Now, let me ask you the question that what is the growth rate of the global, what was the growth rate of the global economy for 2024? What was the global economic growth rate for 2025? And what is expected for the 2026 as per the recent details? And what is the average? What is the average global economic growth rate for the 2000 to 2019 time period? These are the four important data points that you have to remember here. So for 2024, 3.3%, 2025, 3.4%, 2026, 3.1%, and the average global economic growth rate for the period of 2000 to 2019 was 3.7%. Okay, so this is the idea. Now, moving forward with the next part, the global inflation. So we have talked about the growth. Now coming to the global inflation. Okay, global inflation eased. That is, the inflation reduced from 5.8% in 2024 to 4.1% in 2025. Okay, so this is the idea that the global inflation eased to 4.1% in 2025 from the 5.8% in 2024. So this is the idea. Now, why the global inflation reduced? Global inflation reduced from 2024 to 25. That is a good news. The global inflation has reduced. But why it has reduced? Because of the softening energy prices. During this 2025 period, at the global level, the energy prices were softening. The energy prices were reducing. There was normalization of supply chain constraints, even as core and services inflation remained sticky. So the core inflation is the CPI inflation. See, whenever we talk about the headline inflation, retail inflation, we are talking about the CPI inflation. We are talking about the CPI inflation. That is the inflation affecting the consumers. Consumer price index inflation. This is the inflation that is affecting the consumers. Okay. Now, core inflation is basically the CPI inflation, excluding the food and fuel prices that are the volatile prices. So, core inflation is the CPI inflation, excluding the food and fuel prices, excluding the volatile prices. So even though the global inflation, the headline inflation, the retail inflation eased from 5.8% to 4.1%, because of the softening of the energy prices, because of the normalization of the supply chain, but the core and services inflation remained sticky at the global level, okay, for many of the countries. The disinflation, that is the reduction in the inflation rate. This inflation is the reduction in the inflation rate. Inflation is present, but the percentage has reduced. So the disinflation remained uneven across countries, with relative stickiness in service inflation in major advanced economies. So in the major advanced economies, the service inflation, like the inflation, the prices for the service were quite sticky. Okay, this is the idea. Here you have to remember the 2025 global inflation and the 2024 global inflation. Now coming to the next point, that is, we have discussed for 2024, we have discussed for 2025. What is the projection for 2026? So for 2024, the global inflation was around 5.8%. 2025 global inflation was 4.1%. 2026, the global inflation is projected to be higher than the previous year, to 4.4%. Okay. Now the global inflation is projected higher at 4.4% in 2026. This is because of the geopolitical tensions that have recently arose. In January 2026, when the projections were released, there were lower projections for the inflation rate. Inflation rate was only projected at 3.8% for 2026. But now the recent projections show that because of the geopolitical tension, the inflation rate will be around 4.4% for the 2026. Okay? So the idea is that because of the geopolitical tension at the global level, the inflation is expected higher, the growth is expected lower. So global inflation is projected higher at 4.4% in 2026 than the earlier projection of 3.8% that was earlier. Okay? Now, we have talked about growth, we have talked about inflation. Coming to the goods and services, that is the trade. So, world goods and service trade, the world trade volume grew by 5.1% in 2025 from the 3.6% in 2024, exceeding the world GDP growth. So, if we see the growth in the trade, this is higher than the growth of 3.4% of the global economy. So the global economy grew at 3.4% in 2025, while the trade grew by 5.1%. Okay, so world goods and services trade volume grew by 5.1% in 2025, exceeding the world GDP growth in the same time period. Now, merchandise trade volume. Merchandise means when we talk about the goods only. For the goods, the trade expanded by 4.6% in the 2025. Now, when we talk about trade, then you can just remember the current data, 2025 data. You do not have to focus much on the 2024 data. Okay? So from now onwards, like after the inflation, you can focus on the trade data for the 2025 and 2026. Okay? These are the trade data that you can focus on. So for the world goods and services trade, the volume grew by 5.1%. Okay? For the goods only, for the merchandise, the volume of the trade grew by 4.6% for 2025. Driven. Now, why the goods trade improved even though there were tariffs that were imposed and there were the US kind of like US was imposing tariffs and such. So even though there were tariffs that were imposed, then also the goods trade improved because of the front loading of imports in anticipation of the even higher tariffs in the future. So because many of the exporters, they were expecting that there will be even higher tariffs in the future, that's why they were front loading the exports and they were front loading of the imports that were happening. Okay, so front loading of imports in anticipation of higher tariffs and growth in trade of technology. There is trade in technology that has also improved. That's why also the merchandise trade volume expanded by 4.6% in 2025 from the previous year. Now, when we talk about the services, we have talked about the goods and services growth of 5.1%. Goods trade grew by 4.6%. The service trade volume grew by 5.3%. Okay, so service trade grew by 5.3% in the 2025. Now, the post pandemic, so basically, global services trade volume grew by 5.3%, but this is lower than the growth in the 2024. In 2024, the service sector was growing by the service trade. The service trade was growing by 7.8%. But in 2025, the service trade is only growing by 5.3%. Why there is the growth is happening in the service trade, but there is the lower growth that is present? This is because after the post pandemic, like after the pandemic, what happened that there was surge in the travel services, which had already played out in the preceding year. Now, because of the after the pandemic, there were surge in the travel services, there were surge in the traveling. But now this role has been played out, and alongside there was a muted growth in transportation services. In the 2025, there was the muted growth in the transportation services. So even though there was service growth, the service trade has grew by 5.3%, but this is lower than the previous year. So I hope all of this is clear. I've given you all the important data point that you have to remember here. Uh, so focus on the data point. Okay. So in the trade, when we talk about the goods and services combined, so the volume grew by 5.1%. For the goods trade, the volume grew by 4.6%, while for the services trade, the volume grew by 5.3%. Even though the service trade volume has grown by 5.3%, but this growth in 2025 is lower than the growth in the previous year. Now, the service trade growth has moderated because of the post-pandemic surge in travel services. This had already played out in the preceding years, alongside a muted growth in transportation services. Okay. Now, coming to the next part, world trade. Now we have discussed the data for the 2025 for the trade. Now coming to the 2026. The world trade, goods and services combined volume growth projected at 2.8% in 2026. So here you can see that in 2026, we are expecting that whatever tariffs were imposed in the last years, whatever problems arose, that will impact in 2026. That will show its major impact in 2026. And in 2026, the world trade of goods and services combined will only grow by 2.8%, while in 2025, the growth rate was how much? In 2025, the trade volume of goods and services grew by 5.1%, but in 2026 we are only expecting it to grow by 2.8%. So now the impact of the tariff, the impact of every negative thing will go in 2026. Okay. So the world trade, that is goods and services combined volume growth, projected at 2.8% in 2026. This remains highly sensitive to shift in the geopolitical landscape and energy prices driven inflation risk. Now, global foreign direct investment rose in 2025. So the global foreign direct investment increased in 2025 with net inflows to developed economies increasing by 43%, especially Europe and financial hubs. In contrast, the net FDI inflows to developing economies declined by 2% in 2025. So the net FDI inflows increased in the developed countries by 43%, especially in Europe and the financial hubs, while the net FDI for the developing nations declined by 2% in 2025. Okay? This is also important. Now, the last point from the global economy assessment and prospect is that the US dollar depreciated during April 2025 to February 2026. So, from April 2025 till Feb 2026, there was depreciation of dollars. That means dollar was becoming weaker, but it strengthened on safe haven demand after the outbreak of the West Asia conflict. So after the outbreak of the West Asia crisis, that is end Feb 2026, at the end of Feb 2026, the West Asia conflict initiated, or it started with full-fledged. So basically at the end of Feb 2026, with the West Asia conflict outbreak, the US dollar started strengthening because of the safe haven demand. Whenever there is turmoil in the global level, now whenever there is huge volatility, so the people trust dollars more. Will you trust dollars, or will you trust the currency of Vietnam? Will you trust dollars, or will you trust the currency of a small nation? You will trust dollars more, because that is the currency that is used for the world trade and such, for the reserves by many of the countries. Even India is keeping huge amount of dollars in the reserves. So this is the idea that whenever there is volatility at the global level, there is more demand for the dollars. And similarly here also it happened that as soon as the outbreak of the West Asia crisis happened, the demand for dollars increased. Of demand of dollars is increasing, so there will be more value of dollars. The dollar started to appreciate now. So even though the US dollar was depreciating during the year of April 2025 till February 2026, but is strengthened on safe haven demand after the outbreak of the West Asia conflict. The sovereign bond yields remained elevated, that is, the interest on the government bonds, it remained higher amid fiscal concerns, the concerns with the government, with the conflict adding further upward pressure. Okay? Now, coming to the domestic economy, now we are going to start with the domestic economy. Anyone, any confusion? Any confusion? Chalo. Now, all the data that we will see, the real GDP data, the real GBA data, whatever data we will see, this is as per the second advanced estimates that are released by the National Statistics Office on February 27, 2026. This is the most recent data. So, in your economic survey, the first advanced estimates were used. But in the annual report, the recent data is used, that is the second advanced estimates. Okay? So, you have to focus on the annual report data, because this is as per the second advanced estimates that are released more recently and is providing you more recent data. That is the idea. Chalo. So all the references to the GDP, GVA data is, in this report is from the second advanced estimates, and the second advanced estimates, they are with the new base year. What is the new base year for the real GDP? The new base year for real GDP is 2022-23. Okay? Real GDP basically shows the, see, GDP is what? Gross domestic product. It shows the total production that has happened at the domestic level. So total production at the domestic level. Real GDP means that actual increase in production we are going to see. Actual growth in production we are going to see. Okay? So real GDP is the actual growth in the production. Actual growth in the production. So that is real GDP. Now, this is as per the base year. Here we are taking the base year 2022-23. Chalo. Now coming to the data, very important, India remained fastest growing major economy with real GDP expanding at 7.6%. So real GDP expanded by 7.6% for the financial year 2025-26. That is for the recent previous financial year, for the financial year 2025-26. The real GDP grew by 7.6%, which is higher than the real GDP growth in the previous financial year of 2024-25 of only 7.1%. So India remained the fastest growing major economy with real GDP expanding at 7.6%, supported by strong domestic consumption. Here you can see that the private consumption or the domestic household consumption, it is quite high. It was higher than the previous year. Sustained investment, the investment also increased, we can say. Fixed capital formation, that is the asset formation or the investment in the assets, that also improved. Proactive policy initiatives were taken by the government and the monetary authority of our that is RBI. Sound macroeconomic fundamentals, we already have good we already have good fundamentals. The businesses, they are doing fine, the banks, they are healthy, so we have sound macroeconomic fundamentals. On the demand side, private final consumption expenditure, that you can see that the private final consumption expenditure, it has increased. The fixed investment served as the key growth drivers. Even though the exports are reducing, we are able to export less to US. See, India, the major trading partner of India was US. Okay, it was US. Now US has imposed tariffs on us, so of course our exports will be impacted. We cannot deny it. Our exports will be impacted, or they have been impacted. But the good thing is that on the demand side, the private consumption of our country, the investment in our country from the sources. So private final consumption expenditure, fixed investment served as the key growth drivers. Although the imposition of US tariffs initially triggered concerns, but their overall impact remained muted, with net exports exerting a modest drag of 0.1 percentage on the growth. So on the GDP growth, on the growth of the real GDP, which declined by 0.1% because of the US tariffs. So what is the decline? What is the drag that came in the growth of our country because of the US tariffs? Tell me, what is the drag? What is the drag that came in the real GDP of India due to US tariffs? It was only 0.1%. Okay? So this is what you have to remember from here, that the real GDP growth for 2025-26 was 7.6% for India, and the real GDP, in the real GDP growth, the drag was only 0.1%. Sorry, the drag was only 0.1% because of the impact of the US tariffs on the net exports. This is very, very important. Although the imposition of US tariffs initially raised concerns, we are still concerned about this area, but still the overall impact remained muted of the US tariff imposition, with net exports exerting a modest drag of 0.1 percentage point on the growth of our country, on the growth of our country. Chalo. Now moving forward, see, whatever data I have written in a very small part, that is only for your understanding. This data you do not have to cram. Okay? So if you see such small point, that is only for your reading, it is not for remembering. So gross domestic investment rate, measured by the ratio of the gross capital formation, the total capital formation, that is asset formation in the country, as a percentage of GDP, broadly remained stable at 34.3%. So gross capital formation, total capital formation was 34.3% of the GDP. Gross domestic savings rose to 34.2%. It is said that it is good for the country to save more, because when more savings happen, if the saving is invested, so that is good for the country. So the savings, the gross domestic savings increased to 34.2%. Here you can see that our saving and the investment, the asset formation and the savings, they are nearly the same percentage. So that means whatever is being saved in the country, that is also flowing for the investments. Okay? Now saving investment gap narrowed during 2024-25, with the household sector remaining the primary net supplier of funds. Who saves the highest in our country? So it is the households which are the primary net supplier of the funds. They are the ones that are savings the funds, that are supplying the funds for the investment. Okay? So this is the idea. Chalo, moving forward. So read it once, that's it. Now, moving forward with the real GVA. So we have discussed about GDP, but GDP is said to be showing you the expenditure side, the consumption side. Okay. Now coming to the GVA. GVA is gross value addition. That shows you that how much is the value addition that has been done by the producers of our country. Okay. Or in the country, how much of the value addition has happened in the agriculture sector, industries, services. So starting with the aggregate supply measured by the real gross value added. So real gross value added, real means that what is the actual value addition that has happened, or how much is the growth. In the real gross value addition, what is the growth? So it was 7.7%. It was 7.7%, which is even higher than the real GDP growth. Okay. What was the real GDP growth? Tell me fast. Real GDP growth for 2025-26 was real GDP growth for 2025-26 was 7.6%, while the real GVA growth, gross value addition, the value added growth in 2025-26 is 7.7%, so still higher. Now, why the growth has happened in the gross value addition? What are the main factors due to which the gross value addition has improved so much or the growth is quite high? It is on the supply side. On the supply side, a buoyant service sector. Our service sector is the most powerful sector that we have. Our agriculture sector, productivity, like the agriculture, we export a lot of agricultural products, but the productivity is low in agriculture sector, and we still need to improve in the agriculture sector. The manufacturing sector, it still has a long way to go because we do not have sufficient industrial base in our country. We do not have sufficient manufacturing units in our country. That's why make in India programs and such are run, so that we can improve the number of industries or the companies in our country. So service sector is the one that actually is the main contributor in the gross value addition. So on the supply side, a buoyant service sector, robust manufacturing performance. The manufacturing performance was also good, which offset the subdued agricultural activity. Even though agricultural activity was subdued, still the buoyant service sector that has always been the backbone of our country, with the manufacturing sector that remained robust. So the GVA, the gross value addition, was the gross value addition growth, the real GVA growth was 7.7%. Okay. Now, the growth. Now, when we are talking about the gross value addition, we have to talk about agriculture, industries, and services. So, let's start with the discussion on agriculture. So, important data I will provide you. Growth in real GVA in agriculture. So, the growth in the real gross value addition in the agriculture and allied sector decelerated. Here you can see that the growth has decreased. The gross value addition growth has decreased from 4.2% to 2.4%. So for the agriculture sector, that's why it was written that the agriculture activity subdued, because the growth has reduced from 4.2% to 2.4%. Because of now this happened because of the disruption in kharif crops, although the favorable rabi conditions provide support. Next, as per the first advance estimate, the production for the horticulture crops and such, we have the first advance estimates. So as per the first advance estimate, the production of horticulture crops during 2025-26 increased to a record level. Now here what you have to remember is that which horticulture crops, because a question can come from this also, that which horticulture crops were main drivers of the huge record increase in the production in the horticulture area. So mainly the production of horticulture crops were driven by banana, tomato, and plantation crops. As per the second advanced estimates, total food grains production is estimated at a record level in 2025-26. This year is marked with the record production of kharif rice, wheat, maize, groundnut, rapeseed, and mustard and sugarcane. Okay, this is it. So these are the two additional points that just read it once. If a question comes, that is good. Otherwise, you do not have to put more emphasis on this. Now, the GVA, the real GVA growth was how much for 2025-26? It was 7.7%. For the agriculture sector, the real GVA growth, the gross value addition, growth in agriculture sector was 2.4%, which is lesser than the previous period. Now coming for the industrial sector, here you can see the whole data that the GVA at basic prices growth was 7.7%. For the agriculture sector, the growth was 2.4%. Agriculture sector, the growth was 2.4%. Industrial sector. Now coming to the industrial sector, here you can see that the growth of the industrial sector was 9.5%. So real GVA growth in the industrial sector was 9.5%, and this is especially because the growth happened because of which sector? Because of the manufacturing. Because of the manufacturing units. Okay. So industrial sector posted strong growth in 2025-26. So industrial sector, it posted strong growth in 2025-26, driven by a robust manufacturing sector, which is 80% of the industrial sector. So manufacturing sector is 80% of the industrial sector, and the manufacturing sector grew by 11.5%. So even though here you can see that in the mining and quarrying the growth reduced, but because of the manufacturing sector, which is a major chunk of the industrial sector, which grew by 11.5%, the huge growth or good growth was seen in the industrial sector. So industrial sector posted strong growth in 2025-26, driven by a robust manufacturing sector, which makes up 80% of the industrial sector. As per the second advanced estimates, the industrial sector recorded real GVA growth. The industrial sector recorded a growth, GVA, gross value addition growth, real GVA growth of 9.5%. Okay, in which manufacturing sector played a major role by contributing, and by growing at 11.5%. Okay. Now, moving forward with the service sector, as I've told you, that it is the backbone of the economy of the GVA. So, if we are saying that the gross value addition growth happened, the real GVA grew by 7.7%. 69% of the contribution was from the service sector. So the service sector continued to be the primary driver of the aggregate supply, contributing to around 69% of the growth in the real GVA. So the growth that happened in the real GVA of 7.7%, that came 69% was from the push given by the service sector. As per the second advanced estimate, the real GVA growth in service sector is estimated to be 8.7% in 2025-26. That is higher than the previous year growth. And why the service sector grew? Because of the broad-based expansion in the service sector, the trade, transport, hotels, restaurants, financial, real estate, professional services, all of these sectors have seen. Under the service sector, all of these areas have seen good growth. Okay? Chalo. Any confusion? For the real GVA, what was the growth rate? I want you to also keep the data in mind. So for real GVA, what was the growth rate? It was, for real GVA, growth rate was 7.7%. Very good. For the agriculture, the growth rate was 2.4%. For the industries, the growth rate was 9.5%. For the services sector, the real GVA growth was 8.7%. Okay, this is for 2025-26 that you have to remember. Moving forward with the next part, that is employment. So we have talked about the growth. Now coming to the employment. Okay, so when we see the data, the important data is labor force participation rate. The labor force participation rate, according to the annual periodic labor force survey report for January to December 2025, the labor force participation rate, worker population ratio, unemployment rate, all of these have improved as they have declined slightly. Labor force participation rate means labor force as a percentage of population of our country, that has improved because there is sorry, the unemployment rate, it has declined, so that is an improvement. But the labor force participation rate and the worker population ratio, they also showed marginal decline, which is not good. Okay, so unemployment rate, that is, the unemployment rate is the unemployed people divided by the labor force. Labor force is equal to the employed plus the unemployed people. Okay, so labor force is the total of the employed and the unemployed people. So our unemployment rate, it is a percentage of the labor force. So unemployment rate, it reduced from 3.2% to 3.1%. So there is a marginal decline. That means there is improvement. In the unemployment rate, as it has declined, so there is improvement because the unemployment rate declined from 3.2% to 3.1%. While for the labor force participation rate, the labor force participation rate, that is the labor force out of the total population that is participating, is 59.3%. So 59.3%, this is the labor force participation rate for January to December 2025. And the worker population ratio, that is the worker in the total population, the workers, that was 57.4%. This is worker population ratio. Okay. So worker population ratio and the labor force participation rate has declined slightly. So we can say this is not this is not very good for the country. Neutral position is there, but in the unemployment rate, it has declined. So this is improvement. This is good for the country that the unemployment rate is declining, at least slightly also. Chalo. Now rural and urban. Here you can see that the labor force participation rate in the rural area, in the rural area, the labor force participation rate is higher than the urban area. The data point you do not have to remember, just remember that the labor force participation rate is higher in the rural area in comparison to the urban area, and the unemployment rate is lower in the rural area while the unemployment rate is higher in the urban area. So unemployment rate is higher in the urban area while the labor force participation rate is higher in the rural area. Next, the self-employed, now in the category of employment, the highest employed people are in the self-employed category, then the regular salaried, and then the casual laborers. Okay, so what is the biggest? Again, percentages are not important. Remember that the biggest percentage of the employment is coming from the self-employed portion, then the regular salaried, and then the casual laborers. Okay, so this is the idea. Now, coming to the inflation, so we in the domestic economy, we have talked about the growth. Now we have talked about the employment. Now coming to the inflation part. So CPI, do you know that the CPI base year? Now consumer price index, consumer price index. It is an index, so it should have a base year because we want to see the prices that affect the consumer, and we want to see the CPI inflation. That is the inflation that is affecting the consumers. So before, the base year of CPI was how much, or what was the base year of CPI? 2012. Now, what is the new base year of CPI? The new base year of CPI, we have discussed, the new base year of CPI is 2024. So new base year of CPI is 2024. Now MOSPI has released, the Ministry of Statistics and Program Implementation, it has released the CPI base 2024 series since January 2025 with a linking factor. So basically here in this section, therefore, the discussion about CPI inflation till December 2025. So CPI inflation in the coming slides, we'll discuss about the CPI inflation, the retail inflation, the headline inflation till December 2025. Till December 2025, the CPI will have the base year of 2012, while from January 2026, the CPI base year will be considered 2024. Okay? So here till December 2025, the CPI was from the base, was having the previous weightage, or was having the previous base year. Now in the CPI that was having the base year of 2012, it had six product in the basket, or six groups: food and beverages, pan, tobacco, intoxicants, clothing and footwear, housing, fuel and light. While the CPI with the base year, the new base year of 2024, the new series of CPI basically has 12 divisions rather than six groups. Now there are 12 divisions. So this we have already discussed in a session that I took in February. So in February, this announcement happened that the CPI, new series of CPI has been launched with the new base year of 2024, and it will have 12 divisions. While the old CPI series had the base year of 2012 with six groups. Okay. In this case, till December 2025, the data is as per the old series, while from January 2026, the data has been released with new CPI series. That's why it has been clarified here that when we are going to discuss about the inflation data, whenever we talk about 2025-26, that is, we are seeing the yearly data. This data is particularly till the December 2025, because here we are seeing the data of the old CPI series, which is quite different from the new CPI series. So even if here it is written 2025-26, the data is taken only till December 2025 for the CPI, for the consumer price index, because of the old series. Now here let's see this trend, so that when we discuss about the inflation, it becomes easier for you. So in the food and beverages case, you can see that there was, like, from April 2025, from this point onwards, there was deflation that was coming. Deflation means that the food and beverages, the price started to decrease till the December 2025. While for the fuel and light, that is orange here, this is the orange part, fuel and light, this is above, that means there was inflation in the fuel and light section. The prices were increasing, there was inflation. Similarly, CPI, so excluding food and fuel, so core inflation, that is excluding food and fuel, core inflation was also quite high. You can see blue, it is quite higher. Okay, so core inflation, in this also the prices were increasing, there was inflation. So basically headline inflation. Now coming to the data. Till now any confusion? Any confusion? I will take the extra query at the end of the session, AJ Jan. Okay. Right now focus on the content. So any confusion? Now, headline inflation, that is the CPI inflation, the retail inflation moderated to 2.1% in 2025-26 from 4.6% in the previous year. So in 2024-25, the inflation was around 4.6%, which reduced in the previous financial year. The inflation was in the 2025-26 2.1%. Now there is a huge decline in the inflation, and remember that the headline inflation, the CPI inflation, the RBI has the target to maintain the inflation around 4% within the range of plus minus 2%, within the range of plus minus 2%. Okay. So the target is to keep the CPI inflation around 4% within the range of plus minus 2%. This is the target for the RBI. Now here you can see that the target is 4% within the range of 2% to 6%. And the CPI inflation, the headline inflation was around 2.1%. That is near to the lower bound, near to the lower bound. Why the inflation was so low at 2.1%? Because of the muted price pressures in food and a favorable base effect. So basically the food, here you can see that in the food category, in the food and beverages category, the prices were actually decreasing. The prices were actually decreasing. Okay. In the food category, the prices were actually decreasing. It were lower. So because of the less prices in the food and beverages, and the food and beverages in the old CPI series, food and beverages have the major chunk. So because of the decline in prices, because of the decline in prices in the food and beverages sector, the inflation rate decreased. The inflation rate decreased. This is the idea, from 4.6% to 2.1%. Next is core inflation. Core inflation, as I've shown you here also, the core inflation was higher. So it was having some inflation. So core inflation faced upward pressure emanating from precious metals, especially gold. Gold prices were increasing. In the 2025-26 financial year, the gold prices were increasing, and with that, core inflation, that is the CPI inflation excluding food and fuel prices. So core inflation was facing upward pressure, averaging 4.3% for the 2025-26. And here we are taking the data till December 2025. Remember this, because from January the new series is being followed, and that's why, because of the difference in the series, it has been clarified. It has been clearly stated that if we are talking about the CPI inflation, or if we are talking about the inflation, we will take the data till December 2025, because from January 2026 the new series has been used. So we cannot compare, or we cannot include the new series data here. So this is the idea. So headline inflation decreased in 2025-26, or the headline inflation was 2.1%, while the core inflation was 4.3%. Now, towards the end of the year, however, as the conflict in West Asia broke out in end Feb 2025, the conflict in West Asia broke out, and that's why in end Feb 2026. So the financial year 2025-26, it had to end in March 2026, and just before the end of the financial year, there was the crisis that broke out, West Asia crisis, conflict that broke out, due to which the domestic LPG prices started to increase. Because of the West Asia crisis, the domestic LPG prices started to increase. Now, for the prices, let's see. For the price of the food and beverages, they contracted. They actually decreased by 0.8% from April to December 2025. Because of the decrease in the prices of food and beverages, the inflation, the headline inflation, reduced from 4.6% to 2.1%. And the food and beverages prices were lowest in October 2025. In October 2025, the CPI, the Consumer Price Index for food and beverages, that is the prices for food and beverages, recorded the steepest deflation, the lowest of the like prices, we can say, in the year on year if we compare. So in October 2025, the food and beverages were spatially, the prices of food and beverages were spatially lower. Spatially, the muted prices were because of the decline in the prices of vegetables, pulses, cereals. Unlike the overall benign food inflation, the food inflation was not present, or the food prices and the beverages prices were declining, but in certain categories of staples, fruits and in certain categories of fruits, oils, and fats, the prices were increasing. So, for food and beverages, food and beverages from April to December 2025, the food and beverages prices contracted by 0.8%. Especially in October 2025, there was the highest contraction in the prices of food and beverages. This is mainly because of the vegetables, pulses, and cereals, like the staples basically. So the food inflation was declining, or there was deflation, the prices were declining because of the vegetables, pulses, cereals, because of the staples. But in certain food cases like the fruits, oils, and fats, they witnessed upside price pressure. Okay, now coming to the last part, that is from the inflation part, fuel inflation increased to 2.4%. Especially in April 2025, there was the price hike of 50 rupees per LPG cylinder, and the fuel groups contribution to headline inflation. So fuel group contributed to the headline inflation in the 2025-26 to 8.8%. So there was a huge contribution by the fuel inflation. So fuel inflation increased to 2.4% during the April to December 2025, as well as there was the price hike of LPG cylinder that happened in April 2025 and again March 2026, due to which the fuel prices further rose, and the inflation in fuel rose to 0.9%. So this is the idea. So the data here is not very important for the fuel inflation, but the idea is that the fuel inflation, because the food prices were reducing, the fuel inflation was a major contributor, and the core inflation, the gold prices and such, they were the major contributors in the headline inflation. So core inflation was 4.3%, and the fuel inflation increased to 2.4% in April December 2025. Most important is this. Okay. So headline inflation decreased from 4.6% to 2.1%. The core inflation was 4.3%. The headline inflation decreased to 2.1% because of the food and beverages prices, which were quite low, and especially food and beverages prices were lowest in the October. And the low food and beverages prices is basically from the vegetables, pulses, and cereals, while in the category of fruits, oils, and fats, they witnessed upside pressure. But the downside, or the decrease in the other cereals, pulses, it was higher. This is the idea. Now, there was also rationalization and simplification of GST. The GST rates were simplified in September 2025. How many of you remember that there was the rationalization of the GST rates? The rates were like before, there were multiple rates which were declined. I hope you all remember. Now, coming to the next part, during 2025-26, the Reserve Bank undertook, so GST rationalization happened. GST rationalization happened, due to which also, because the goods and services tax was rationalized, that's why also the prices, the inflation was not much high in 2025-26, or it declined from the previous financial year. Okay? Yes. Now, coming to the next part, that is during 25-26, the Reserve Bank undertook several innovative initiatives. See, in Gujarat and Puducherry and Chandigarh. So, Gujarat, Puducherry, and Chandigarh, public distribution system beneficiaries, the PDS beneficiaries, they were credited the food subsidy through programmable CBDC. Programmable CBDC means that in the central bank digital currency. So, central bank digital currency is a kind of substitute to the physical currency. So, rather than having 100 rupees, you can have the central bank digital currency. In that you can have 100 rupees. Okay, so rather than having the physical note, you can have the central bank digital currency. So programmable CBDC is basically the CBDC that can be used for certain particular areas or for certain particular things only. So it has been seen that through the programmable CBDC, the direct benefit transfers can be provided, or the subsidies can be provided, so that the subsidy is being used for a particular product only. So if we are using programmable CBDC, if it is for this fertilizer, we will only be able to use this central bank digital currency in the fertilizer shop. If it is for the LPG cylinders, we will only be able to use this programmable CBDC to pay to the LPG suppliers. Okay, so that is programmable CBDC. So in Gujarat, Puducherry, and Chandigarh, public distribution system beneficiaries were credited food subsidy through programmable CBDC that is only redeemable for eligible commodities at the fair price. As well as there is the asset tokenization, that means like your credit card details are getting tokenized. Rather than giving your card number, rather than giving your CVV, you can give the token, or there is the tokenization of your card details that is happening. Similarly, it has been said that rather than keeping the assets or the securities in their raw form, it can be kept in the tokenized form, so that the securities, even if they are getting stolen, the deciphering will not be possible, or the securities cannot be misused. So asset tokenization, the Reserve Bank developed for the asset tokenization, the Reserve Bank developed the unified market interface, a multi-layer platform to facilitate tokenization of financial assets while using the wholesale CBDC. Now it has been said that there is the pilot. What you have to remember here, that there is the pilot on tokenization of certificate of deposit. So the first product or the first security that will be tokenized is the certificate of deposit. This was initiated under the unified market interface. So Gujarat, Puducherry, and Chandigarh, in these areas or states or the union territories, there is the programmable CBDC that has been provided to certain customers, as well as the asset tokenization. For that, the pilot has been in the domain of UMI, Unified Market Interface, with the certificate of deposit. Next is that there is the digital asset collaboration with the Monetary Authority of Singapore. So bilateral discussions happened with the Monetary Authority of Singapore and the Central Bank of UAE. They were held for operationalizing a cross-border central bank digital currency pilot. So Reserve Bank also joined multilateral BIS Innovation, Bank for International Settlement Innovation Hub led initiatives such as Project Rialto and Phase 2 of Project Mandala, which are focused on enhancing cross-border payment through CBDCs. So this is further, you can read that the RBI has been taking further steps. On the supervisory front, the RBI is addressing the rising prevalence of cyber-enabled frauds, or RBI is looking after to enhance the cyber resilience. Know your customer detail, or the know your customer has to be made stronger, so that the anti-money laundering can be promoted, cross-border supervision is being strengthened. So RBI is working in on these domains, and for that, Reserve Bank has released 64 draft master action across 9 functional areas. Now, in which areas the programmable CBDC was provided for the food subsidy? Gujarat, Puducherry, and Chandigarh. Which is the product on which the pilot has been launched for the asset tokenization on the UMI, on the Unified Market Interface certificate of deposit? Okay, which monetary authorities the bilateral discussion has happened? MAS, Monetary Authority of Singapore, and Central Bank of UAE. Which projects have been joined by RBI with the BIS Innovation Hub led Project Rialto and the Phase 2 of Project Mandala? Next is the government has launched Bharat Gen in June 2025. This is India's first government funded sovereign, that is government multilingual multimodal large language model aimed at developing AI systems that are tailored to Indian languages, not English or such particular languages, like those are also used by us, but Indian, further Indian languages. Okay? In February 2026, the India AI Impact Summit was held, which concluded with the adoption of the New Delhi Declaration on AI Impact. Now, the Reserve Bank of India Digital Payment Index, it shows us the deepening and the penetration of the digital payments. It grew. The Digital Payment Index, it grew by 11%, showing further a deepening and penetration of the digital payments in the country in the financial year 2025-26. UPI volume has increased by 30% in 2025-26, surpassing 200 billion transactions in a financial year. To reinforce India's manufacturing ambitions in the Union Budget 2026-27, this we have discussed in our LPS live practice session also, that in the Union Budget 2026-27, under the which Kartavya? Under the first Kartavya, there was the mention of the 7 strategic and frontier sectors. Okay? So, to reinforce India's manufacturing ambitions, the Union Budget 2026-27 has earmarked 7 strategic and frontier sectors: electronics, semiconductors, biopharma, rare earths, chemicals, textiles, capital goods. In the capital goods, we understood about the container manufacturing. Now, India ranked third. So, coming to the last part, India ranked third globally with installed renewable energy capacity. Okay, so in the rankings are very important, and India has ranked third globally with the installed renewable energy capacity exceeding 250 gigawatts. Okay, renewable energy, including large hydro, which accounts for nearly 1/4 of the power generation in our country, grew by 18.4%, by the end of March 2026, India's non-fossil fuel energy capacity reached to 83 gigawatt. Not important. Here, the important part is that India is ranked third globally in the case of installed renewable energy capacity exceeding 250 gigawatts. Renewable energy accounts for nearly one fourth of the power generation, which grew by 18.4%, and it with the increase of the India's non-fossil fuel energy capacity. There is the increase in the India's non-fossil fuel energy capacity. We are generating the energy through other sources rather than fossil also, and this has enabled India to meet its Committee of Parties 26 target of 50% non-fossil fuel capacity well ahead of 2030. So by 2030, we had to achieve 50% of the non-fossil fuel energy capacity. Okay, non fossil fuel energy capacity. Now till February 2026, I think we achieved 53% around that. So we have achieved the target well ahead of 2030. Now coming to the domestic economy prospects, real GDP. So till now we have discussed about the assessment that has happened. Now coming to the prospects, real GDP growth for 2026-27 is projected at 6.9% with the risk tilted to downside. Okay, uh, so basically 2026-27 real GDP growth for 2025-26 was 7.6%, which is projected. Now the real GDP growth for 2026-27, this is projected at 6.9%. This is projected at 6.9%. Okay. So real GDP growth for 2026-27 is projected at 6.9%. The updated quantitative nationally determined contribution have been laid down. So the nationally determined contributions targets have been updated because we have reached to the target. The target was 50% of the non-fossil fuel uh, energy capacity by 2030, but we have already achieved it. So now we have updated the nationally determined contribution targets, which have been updated for the period of 2031 to 35, include achieving 60% of the installed electric capacity from the non-fossil sources, reducing the emission intensity of the GDP, reducing the carbon dioxide emissions or the emissions intensity of GDP by 47% from the 2005 levels, and creating the carbon sink by afforestation and such, by creating the carbon sink of 3.5 to 4.0 billion tons of carbon dioxide equivalent by 2035. This is the target. Okay. CPI inflation, now real GDP growth for 2025 for 2026-27 is projected at 6.9%. CPI inflation for 2026-27 is projected at 4.6%, which was only 2.1% in 2025-26. It is now, the headline inflation is now projected at 4.6% for 2026-27. Okay. So remember, for 2025-26, the real GDP growth was 7.6%, which is now projected at 6.9% for the 2026-27. And for the inflation, it was 2.1% in 2025-26, which is now projected at 4.6% for 2026-27. On March 25, 2026, the Government of India did the second review of the flexible inflation target, and it was decided, the Government of India has decided in consultation with the Reserve Bank of India, that the CPI headline inflation, the CPI inflation will be the target, and the inflation should be kept around 4% within the range of plus minus 2%. So the inflation is targeted at 4%. It should not go below 2%. It should not go above 6%. That is the idea. So 2% is the lower tolerance level, 6% is the above tolerance level. Domestic bond yields could face upward pressure if the global monetary easing cycle stalls. So just the idea. Now, globally, India has been ranked third for AI competitiveness and ecosystem vibrancy. So, globally, India has been ranked third for AI competitiveness. AI is an important topic. According to FDI markets, India ranked fifth in global greenfield announcements, the new projects that have been announced in the AI related sectors such as data processing and semiconductors. In that particular area, we are ranked 5. So, India has been ranked third for AI competitiveness and ecosystem vibrancy, while the India has been ranked fifth for the greenfield project announcements in the AI domain. Okay? the Union Budget 2026-27 announcements pertaining to tax holiday. So there is a tax holiday that is provided till 2047 for any foreign company that provides cloud services to the customers globally from India. Okay? Safe harbor basically means that if the profit is attained, like 15% of minimum profit has been attained. If 15% of the minimum profit has been attained, in this case, if minimum 15% of profit has been attained, that is a safe harbor margin. That is a safe harbor margin. In this case, the transfer pricing audit will not happen. The pricing audit will not happen if the services are provided to the related entities. If the services are provided to the related entities. So safe harbor is a predefined profit margin. If 15% of the profit margin is attained, in this case, even if the company is providing the services to its own related entity of a foreign country, in this case, the transfer pricing or the audit basically will not happen. So these are the announcements in the Union Budget of 2026-27, which is again discussed in annual report. So it becomes important that there is a tax holiday that is provided till 2047 to any foreign company that provides cloud services to customers globally from India. Safe harbor margin has been announced at 15% if the services are provided to the related entity. The transfer pricing and the audit will not happen if the profit is 15% that is generated. Okay. Infrastructure investments to the tune of $250 billion committed till 2047 in the India AI Summit 2026. This augurs well for attracting the FDI, foreign direct investment. So infrastructure investments to the tune of US dollar 250 billion. This has been committed till 2047. Additionally, measures such as liberalizing FDI norms in the space sector by permitting up to 100% FDI in the satellite manufacturing and components. In March 2024, the government had launched India AI Mission with an outlay of INR 10,372 crores. With the boost that the government is giving towards the AI sector, the private investment also increased around, and it became around $11 billion during 2013 to 2024. This is the idea. So India is ranked third in the AI competitiveness. It is ranked fifth in the greenfield announcements in AI related subsectors, as well as infrastructure investments to the tune of $250 billion were committed till 2047 in the India AI Summit. The government has launched this India AI mission with an outlay of 10,372 crores, and the private investment is also happening in our country for the AI sector. Now, coming to the second part, that is economic review. Now, we have discussed the assessment and prospects. The assessment and prospects have been discussed. In the economic review, the real economy, the price situation, there were a lot of data that was provided under the economic review and the assessment and prospects also. So I have combined that, and in the previous, like whatever data that we discussed for the real economy and the inflation, so that is also taken from the economic review. So again and again, we do not have to discuss the same thing. Now, these are the four areas that we have to discuss. So it will not take much time. Now, starting with money supply. Repeat what, Priyanka? Now, money supply. As at end March 2026, the Reserve Bank's balance sheet size stood at 26.4% of the GDP. Okay, so the Reserve Bank's balance sheet size stood at 26.4% of GDP. This is important data point. M3, that is the money supply. RBI calculates the money supply in our country through the M3, which take into account the currency with the public plus the deposits in the form of demand deposits and the time deposits. Okay, so that is included in M3 plus other deposits of the RBI. So this is the M3. This is how the RBI calculates the money supply in the country, the currency with public plus the deposits, demand deposits, time deposits, and the other deposit with RBI. So M3 recorded a growth of 13% as on March 31st, 2026, as compared with 9.4% in the previous year. So the money supply has recorded a growth of 13%. Now coming to the next part, that is credit growth. So basically, double-digit growth in bank credit was sustained during 2025-26. So there was double-digit growth in the bank credit. This was led by services and retail sectors. So a lot of credit was given to the service sector and the retail sector. Public sector banks registered higher. So here you can see that the public sector banks, they have registered the higher share in total scheduled commercial bank credit. So out of the total scheduled commercial bank credit or the loans that are provided by the scheduled commercial bank, the higher portion is provided by the public sector banks, and 40%. This much is the share of the private sector banks. So public sector banks registered higher credit growth than that of private sector banks for the second consecutive year. This has been seen, resulting in the rise in public sector banks' share in total credit. Now, the personal loans, they continue to remain the major driver of the overall credit growth. And under the personal loans, the housing loans, they account for nearly half of the personal loans. Now, coming to the next part, that is central government finances. M3, that is the money supply. The RBI calculates the money supply in the country through the M3. M3 is basically the currency with public plus the deposits with the banks, that is the demand deposits and the time deposits plus the other deposit with RBI. Now the M3, that is the money supply in 2020. 526, the money supply has grown, or as on March 31st 2026, that is the end of the financial year, the money supply grew by 13%. So there was a growth of 13% in the money supply. That's it. Okay. Now, coming to the central government finances, union government reaffirmed its commitment of fiscal discipline. So basically, the government said that we are going to reduce the fiscal deficit. Fiscal deficit is what? Fiscal deficit is the fiscal deficit. This is basically the fiscal deficit is equal to total expenditure of the government minus total receipts excluding borrowing. If the government is spending 100 crores while the government is receiving through the revenue, through the taxes, through the dividends, through fees, fines, the government is receiving 90 crores excluding borrowing. Here we are excluding the borrowing. So the fiscal deficit is 10 crore. It is 10 crore. Now the government, if the fiscal deficit is 10 crore, that means this is the extra expenditure that the government is doing. How the government will cover this extra expenditure that the government is doing? Through borrowings, because only borrowings are left, so government will have to borrow 10 crores. So fiscal deficit, it shows the borrowing requirement of the government. Now the government committed to reduce the fiscal deficit, because if the fiscal deficit is very high, that means the borrowing requirement of the government is very high. So government reaffirmed its commitment to fiscal discipline by reducing the gross fiscal deficit to below 4.5% of GDP in 2025-26. And in so here you can see that in 2025-26, the fiscal deficit was 4.4% of GDP. So fiscal deficit was 4.4% of the GDP in 2025-26 as per the revised estimates. And as per the budget estimates, the fiscal deficit is, as per the budget estimate, the fiscal deficit will be 4.3% of the GDP in 2026-27. The fiscal deficit, it was 4.8% of the GDP in 2024-25. So you can see that the fiscal deficit, it was 4.8% of GDP in 2024-25, but it was only 4.4% of GDP in 2025-26, and the government is further going to reduce the fiscal deficit to 4.3% of GDP in 2026-27. I hope this is very much clear. So government promised in the union budget of 2021-22, the government promised to bring its fiscal deficit at below 4.5% of GDP. So government in 2021-22 union budget promised that the fiscal deficit will be brought below 4.5% in 2025-26. And now if we see the data for 2025-26, the fiscal deficit was actually below 4.4%, 4.5%. It was 4.4% in 2025-26. And for 2026-27, it has been said that the fiscal deficit will be further lower at 4.3% of the GDP. I hope this is very much clear. Next is capital expenditure is budgeted. Capital expenditure, this is the expenditure that the government is going to do on asset formation or reducing its liabilities. So capital expenditure is budgeted to grow by 11.5% in 2026-27. The center's debt to GDP ratio. So center's debt to GDP ratio declined from 56.1% or the government is expecting it to decline from 56.1% to 55.6%. So in the union budget, it was said that the debt to GDP ratio in 2026-27 will be 55.6%. Okay. Next is central government thrust on growth, inducing capital spending. The government is focusing on capital spending on the asset formation. On the receipt side, direct taxes are budgeted at 6.9%. Here you can see that the direct taxes, they are expected to improve in 2026-27, and they will become 6.9% of the GDP, highest in more than a decade. This will be highest in more than a decade. Okay. Revenue expenditure, so this is not something that you have to remember. This is what you can read, that in 2025-26 the revenue expenditure increased because of the higher interest payments and major subsidies that the government had to cater to. Effective capital expenditure, this is the capital expenditure plus the grant and aid for creating the capital asset, this is budgeted at 4.4% of GDP in 2026-27. Okay, just give me a second. This is all I can do. Okay. Chalo, now coming to this. Yes. So the important point here is the fiscal deficit. This is the data that you have to remember for 2025-26. It was 4.4%, which was lower than the 4.8% in the previous financial year, and the fiscal deficit is further expected to go down to 4.3% in 2026-27. Okay, read the data once so that you are able to remember the important points. These are the most important points that have been laid down here. Okay. Now, coming to the next point, that is as per now the state finances. Now coming to the state finances. As per the information available for 24 states, union territories for 2026-27, their consolidated gross fiscal deficit as a ratio of gross state domestic product, it is budgeted at 3%. At 3%, it is budgeted at 3% for 2026-27. Okay. So for 2026-27, the gross fiscal deficit as a percentage of gross state domestic product. So like for the country, there is gross domestic product. For the states combined, there is gross state domestic product. So gross fiscal deficit for the states, it is expected to be 3% as a percentage of gross state domestic product. Okay. The gross transfers, the total transfers to states from the central government have been budgeted to increase by 12.2% for 2026-27, largely on account of transfers under the centrally sponsored schemes and special assistance to states for capital investment. So the special assistance for states, under special assistance to states for capital investment, this is a kind of scheme that has been launched by the central government. Under this scheme, there is special assistance that is provided to the states for capital investment, where the central government is providing a loan to the state government at no interest for 50 years. For 50 years. So the scheme of 50 year, this is the scheme for 50-year interest free loans by the central government to the state government, so that the states can use this money for capital expenditure. So this is the idea. Okay. So this is the scheme of 50-year interest-free loans for capital expenditure to states. This would be continued in 2026-27 with an outlay, with the total outlay of 2 lakh crore. This is an increase of 33.3% from the previous financial year. Now, 16th Finance Commission 2026, that provided the recommendation for the 2026 to 2031 financial year, has proposed an allocation of 7,91,000 crore in grants for the rural and urban local bodies. This includes a substantial 194.3% increase in grants to the urban local bodies to address the evolving challenges of the urbanization. Okay. So there is the higher grants that are going to be provided to the urban local bodies so that they can focus on urbanization. Now coming to the now this is the last sector that we have to discuss in the part 2, part 1. So external sector, merchandise trade. So India's, any confusion till now? Budgeted means it is in the union budget. All of this data is from the union budget, like it is budgeted. In the union budget, this data has been provided. Okay. So for the union budget 2026-27, for this financial year, the fiscal deficit was given, budget estimates were given. It was said that the capital expenditure, so capital expenditure here you can see, it will be increased from 11 lakh crore to 12.2 lakh crore. So 11.5% of the increase in capital expenditure. Okay. So this is the idea. The state finances. So this is for also in the 2026. 27 Union Budget, it was informed that so many of the grants will be provided to the states. Now, coming to the external sector, that is the last sector that we have to discuss. Then we will move to the part 2. India's merchandise trade deficit. So, merchandise, that means goods. So, when we talk about the goods, so India's goods trade deficit. So, India's trade deficit in the goods and the merchandise widened to US dollar 333.2 billion during the 2025-26. India's merchandise exports. So basically, the merchandise, the goods exports, they increased by 0.9% in comparison to the merchandise imports that increased by 7.6%. So you can understand that the goods exports increased by a minor of 0.9% during 2025-26, while the merchandise imports, the goods imports, they increased by how much? They increased by 7.6% in the financial year 2026 in the financial year 2025-26. That means the exports increased, but the increase in export was very less than the increase in the imports. So imports are more than the exports in the goods. In the goods, we are exporting less. Exports are less than the imports. So what will happen? If we are exporting less than the imports, what will happen? In the goods category, there is the deficit. There is a deficit. And how much is the deficit? So merchandise, the goods trade deficit widened to $332 billion. This much is the deficit in our trade, in the goods trade. Okay? This is the idea. Now, among India's top export commodities, exports of electronic goods recorded fastest growth. So here you can see that you don't have to remember the numbers in this case, just see that which is at the top position. So electronic goods, they are contributing, they are a major contributor in the exports. After the electronic goods, engineering goods, then meat, dairy, poultry products, then marine products, and so. So among the India's top export commodities, these are the top export commodities, or these are the these are the top contributors in the export of our country. The among India's top export commodities, exports of electronic goods, they grew by 24.4%. They grew by 24.4%. So that means the exports of electronic goods recorded fastest growth. This growth was largely driven by exports of mobile phones, which constitute around 61% of electronic goods. In the case of import growth, our import grew. The goods import, it grew by 7.6%. This was majorly because of the import of electronic goods, gold, machinery, electrical and non-electrical, silver, and fertilizers and such. So you have to remember the names and the contributors rather than percentages. The major contributor in the export growth, the major contributor in the export growth is the electronics good, then engineering goods, then meat, dairy, poultry products, and the marine products. The major contributor in the import growth is the electronic product, gold, then machinery, electrical and non-electrical equipments, then silver, petroleum crude and such. Okay. Now, the export growth was least, or there was negative. So basically, the decline happened in the export of petroleum products and such. This is the idea. Now, in a major trade reconfiguration, China became the largest trading partner of India, overtaking the US in 2025-26. That's why I said that in the previous years, US was the major trading partner of our country, was the largest trading partner of our country. US is still a major trading partner of our country, but it is not the largest now. China has become the largest trading partner of India, overtaking the US in 2025-26. Now, coming to the next part, major sources of crude oil import. We import the crude oil. So the share of Russia, the share of Russia, the share of Iraq has reduced in India's crude oil imports, and the share of Saudi Arabia, share of UAE and US has increased in the crude oil imports of India. This is the idea. So merchandise trade deficit widened in 2025-26 with oil deficit. So you know that merchandise trade deficit, that is the trade deficit in goods, have increased, and this is with oil deficit remaining the largest contributor. So we are having a huge trade deficit. We are having a huge trade deficit in the goods because of the huge oil deficit that we have. Okay? Among the major trading partners, remember this, trade deficit is with China and Switzerland. This has widened while the trade surplus improved with respect to Spain. Okay? So trade deficit has widened with respect to China and Switzerland, while the trade surplus has improved with Spain. Or in as of April 2026, India has signed multiple trade agreements, accelerating the trade diversification efforts. So India has signed a comprehensive economic and trade agreement with the UK, with Oman, with New Zealand, and there is also the free trade agreement negotiations with the European Union. Now, next is so till now we talked about the goods. Now, coming to the services. Services is actually the backbone of our country, and that is letting India survive basically. Net service export. Net service export is basically the export of services minus the import of services. So net service export grew strongly by 15.3%. That means we are exporting more than what we are importing, and the net service export grew by 15.3%. So net service export grew by 15.3% during April December 2027. Okay, 2025, sorry, driven by software and business services. So net service export grew strongly by 15.3% for April December 2025, driven by software and business services. Now, when we talk about services, so in the balance of payment, where we record the transactions that we are doing with the rest of the world, in the current account we have trade in goods, we have trade in services, and we have transfer payment. Okay, so in the trade in goods there is deficit, because we are exporting less than what we are importing. In the trade in services there is net surplus, because the net services export grew, so there is a surplus. Transfer payment. Now coming to the transfer payment, remittances specially. We receive, so private transfer receipts, mainly representing remittances by Indians working overseas, posted a robust growth. So there is growth in the remittances also that we are getting from the Indian working overseas. This posted a robust growth of 10.1% in April to December 2025. The average cost. Now this is also important. The average cost of sending $200 as remittance to India stood at 5.3%. So what is the average cost of sending remittance to India? If remittance is being sent to India, so the cost of $200 is around 5.8%. Sending $200 to India, so the cost is around 5.3%, which is lower than the global average cost of 6.4%. But the target under the Sustainable Development Goal, the target of the cost of remittance is 3%. So remember, this is very important, that under the Sustainable Development Goal, there is the target to reduce the cost of remittances that are in between the countries. The remittances are going, so reduce the cost to 3% by 2030. Currently, the cost in India, receiving the remittances in India, the cost is 5.3%, which is lower than the global average of 6.4%. Now, these percentages, even if you are not able to remember, it is fine, but this is very important because the target is 3% by 2030. Okay. Now, there is surplus in the current account. So, basically, in the current account, there is deficit in the trade in goods, there is surplus in trade and services, and there is surplus in the remittances that we are receiving, the transfer payment. But the surplus, the trade in services and the remittances, the transfer payments, they are collectively called invisibles. So the invisibles are in surplus, but the deficit in trade and goods is higher than the surplus in the invisibles. Okay, so the buoyancy or in net services receipt, so there is surplus in the net services. Worker remittances largely offset, so net services or the surplus in the services, the surplus in the transfer payments, they largely offset the trade deficit in the goods, but still the deficit is higher in the goods, and that's why the current account is in deficit. The current account, even though has in the current account the services are in surplus, transfer payments are in surplus, but the good is in deficit. That's why the current account deficit is at $30.2 billion with that is 1.1% of the GDP. Okay, so the current account is still in deficit of $30.2 billion, that is 1.1% of GDP. Now, this was about the current account. What is the capital account? What is the capital account? Capital account of the balance of payment, it records the transactions with the other countries in regards to investment. We are getting the foreign direct investment, we are doing the foreign direct investment in other countries, we are getting the foreign portfolio investment, we are doing the foreign portfolio investment in other countries. There is also the borrowings, the external commercial borrowing, we are lending and such. So capital account, the capital flows, it witnessed significant volatility during 2025-26. The FDI inflows, foreign direct investment, there was net FDI inflows. That means we received more foreign direct investment than we did outside. But in the case of foreign portfolio investment, it declined. The net foreign portfolio investment that we received declined. Okay? So net FPI and the net external commercial borrowings, they fell during the year. And this is a problematic situation because in the capital account, see, the current account is in deficit of $30.2 billion. Now the capital account also, in the capital account, the FDI was in surplus, but the FPI and the external commercial borrowing was in deficit. So the capital account in total was in deficit. So there is, in the current account there is deficit, in the capital account there is deficit. So both the accounts were in deficit. Okay, the current account and the capital account. So globally, India is ranked second. India is ranked second in terms of new FDI announcements or the new projects for which FDI was received. After US, India is ranked second. So after US, India is ranked second for the greenfield FDI announcements. Now, coming to the next part. So FDI, we received the most FDI in the service sector. FDI, there is net FDI inflow. Net FDI inflow. That means the FDI was in surplus, and majorly the FDI was in surplus because of the service sector, because the service sector has received a lot of FDI. Okay? Major source countries from where we received the FDI is Singapore, US, Mauritius, Japan, Netherlands, and UAE. Now, if we are receiving the FDI, we are also doing the FDI in other countries. We do the outward FDI is majorly in Singapore, US, UAE, Mauritius. Okay? So this is the idea. Now, during 2025-26, as I've told you that net FDI inflow was there. That means we received more than what we gave out. But in the FPI case, it registered net outflows. That means foreign portfolio investment outflow was there. So deficit was there basically. In the external commercial borrowing also, there was like deficit. That is the idea. Now, current account was in deficit of $30.2 billion. So current account was in deficit of $30.2 billion, while the capital account was in deficit of $0.6 billion. So what was the total deficit? What was the total deficit in the balance of payment? It was $30.8 billion. So if the balance of payment is in deficit, that means current and capital both are in deficit, the balance of payment is in deficit. So these payments have to be covered through the foreign exchange reserves. These payments have to be covered from foreign exchange reserves. So net capital flows fell short of financing current account deficit. Usually what happens now that the current account, the capital account, sorry. Usually what happens that the capital account is in surplus. So it is able to cover current account deficit. So usually the capital account remains in surplus, which covers the current account deficit. So the balance of payment is in balance of payment, at least the capital account is able to cover a part of the deficit. So the balance of payment deficit reduces. But this time the capital account was itself in deficit and the current account was also in deficit. So there was the balance of payment deficit of $30.8 billion, which were covered through the foreign exchange reserves. So foreign exchange reserves on the balance of payment basis depleted by $30.8 billion. This we already have discussed in the half yearly management of foreign exchange reserves report in YouTube. Next, foreign exchange reserves remained adequate in terms of metrics of reserve adequacy, including import cover of about 11 months for the goods and external debt cover of 90.3%. So the foreign exchange reserves that we have, they are able to cover the merchandise import cover of about 11 months, and they are able to cover external debt that we have of 90.3%. So if anything bad happens also, then also the foreign exchange reserves, they are sufficient to pay back a major portion of the external debt that our country has. And if we take the import cover for goods and services both, Here we are only taking for goods. Here we are taking for goods and services both. So at end March for 2026, the foreign exchange reserves are sufficient to cover 9 months of import of goods and services both. Even if we are not exporting, import only happens, then also we have the 9 month of coverage through the foreign exchange reserves. Any confusion? Yes, these amounts are important because they have been discussed again and again and again in different reports. Okay, and from this particular, like how many months of coverage is provided through the foreign exchange reserves for the merchandise, this question has come in 2023 or 2024 RBI Grade B examination. So such questions have been seen. Now these are the additional points, after which our part 1 will be done. Okay, so on the final trading session of 2025-26, so in the end of the 2025-26 financial year, the 10-year generic government security interest crossed 7% mark, that is for the first time since July 2024. Private placements remain the preferred channel. So in the bond market, that is for the debt instruments, the private placement happens of the debt instruments. Private placement means that a group of investors, the debt instrument is provided to only a group of investors. So private placement remained the preferred channel, accounting for 99% of the total resources that were mobilized through the domestic bond market. INR traded with a depreciating bias during 2025-26 and crossed lower by 9.9%. So in this financial year, the INR depreciated, closed lower by 9.9%. As on March 31st, 2026, this you can read, not very important. Now, coming to the next part. Part 1 is done. Any confusion? Foreign exchange reserves. See, India has the foreign exchange reserves of 691.1 billion dollars. Okay? So these are the foreign exchange reserves that is given, that at end March 2026, the foreign exchange reserves were US dollar 691.1 billion dollars. So these dollars, these billion of dollars of foreign exchange reserves with the RBI, they are able to cover 11 months of goods imports, 9 months of goods and services imports, and they are able to cover 90.3% of external debt. That in any condition in which India becomes in problem, we are not able to trade, we are not able to export, then also we will be able to import for 9 months of the goods and services, 11 months of the goods only, and 90.3% of external debt we will be able to repay through our foreign exchange reserves. I hope this is clear now. Now, coming to the part 2. See, I knew that the session will be lengthy because I not only wanted to discuss the data points with you, but I also wanted to highlight that what are the important data points. So that's why the part 1, which is data heavy, we have discussed it in length. Now in the part 2, today we are going to discuss only 4 chapters, and the rest will be discussed in the next session. So do not worry, we will finish the session just in 30-40 minutes. We will finish the session. And remember that these we already have discussed, like the working and operations of the Reserve Bank of India, April 2025 to March 2026. So you must remember many of the things that has already been discussed in the sessions. Okay? Even if you are not able to remember, do not worry. There is not much details that we have to cover in these chapters. So you don't have to worry much about it. The most data heavy part, or the most important data heavy part, was part 1 that we have completed now. Okay? Now we are going to start with the part 2. Today we will focus on a few chapters, and then in the next session on Tuesday I will take your next session where we will discuss the rest of the chapters, and MCQs will also be discussed in that. Okay? Chalo, let's start. Monetary policy operations. So we are starting with the working and operations of the Reserve Bank of India. We are starting with the monetary policy operations. So monetary policy operations, let me provide you the brief idea so that we will be able to cover this chapter in 5 minutes only. See, in the monetary policy operations, do you remember that when was the first time, in which particular month, the repo rate was decreased? Which particular month was it when the repo rate was decreased? Such a question has been asked in 2024 examination, and this kind of question can also come. That in the past financial year, which was the month in which the repo rate was for the first time decreased after the increase and being stable at 6.5%. So the repo rate was first decreased in February 2025 from 6.5% to 6.25%. 6%. Okay, so repo rate was decreased from 6.5% to 6.25% in February 2025, and after that in April 2025 till December 2025, there was the decrease in the repo rate. There was the continuous decrease in the repo rate, or there was the decrease in the repo rate. CRR was also decreased, that we also have to discuss. So monetary policy operations, actually all of this you have already studied, but here you will be able to revise, as well as you will be able to focus on the important points that you cannot forget from the examination perspective. So basically, the easing cycle initiated in February 2025. So repo rate, that is the lending rate of the Reserve Bank of India at which the RBI lends the money to the banks. So repo rate was decreased for the first time, like the easing cycle started in February 2025. After that, again in April 2025, there was further decrease in repo rate. Okay, so in February 2025, the repo rate was decreased by 25 basis points, that is by 0.25%. Now, in the financial year 2025-26, because we are talking about financial year, so in financial year April 2025 to March 2026, in this financial year, the repo rate was decreased by 100 basis points, that is by 1%. Okay, so the repo rate in February 2025 decreased from 6.5% to 6.25%, and from April 2025 till March 2026, the repo rate decreased from 6.25% to 5.25%. Anyone knows that what is the current repo rate? Because from April 2025 till March 2026, the repo rate decreased from 6.25% to 5.25%. What is the current repo rate? It is 5.25%. Okay, the last decrease in the repo rate was done in December 2025, and after that, the repo rate has been kept at 5.25%. This we are going to discuss in the monthly manner, so you don't have to worry about it. This is just a basic summary. Okay, let's come to the month-wise manner so that you are able to remember this. So basically, here you can see that the Monetary Policy Committee, for the first time, decreased Monetary Policy Committee after a long time decreased the repo rate in February 2025 from 6.5% to 6.25%. Then in April 2025, that is the start of the next financial year, from April to March 2025-26. So with the start of the financial year, the repo rate was further decreased by 25 basis point from 6.25% to 6% by 25 basis point. Then in June 2025, a major decision was taken that the repo rate will be decreased by 50 basis point in one go. So in June 2025, the repo rate was decreased from 6% to 5.50%. Then in last December 2025, the repo rate was decreased from 5.50% to 5.25%. Okay, so December 2025, the repo rate was decreased from 5.50% to 5.25%. So remember this. Repo rate was decreased from Feb 2025, but in this financial year, the repo rate was decreased by 25 basis point, then 50 basis point, then 25 basis point. So in total, 100 basis point was the decrease in the repo rate in 2025-26 financial year. The policy stance was also shifted from neutral to accommodative in April 2025. So basically, the policy stance was shifted. With the decrease in the repo rate in April 2025, the repo rate was decreased. And at the same time, in April 2025, it was decided that rather than having the neutral monetary policy stance, we will have the accommodative monetary policy stance. In June 2025, when the repo rate was decreased by 50 basis point, it was said that rather than having the accommodative monetary policy stance, we will have the neutral monetary policy stance. Okay? So this is what you have to remember, that the Monetary Policy Committee in the financial year April 2025, June 2025, and December 2025. In April 2025, the repo rate was decreased by 25 basis point. June, 50 basis point decrease in the repo rate. December, 25 basis point decrease in the repo rate. April, the stance was changed from neutral to accommodative, that in the future we are going to reduce the repo rate. But in June 2025, the stance was again changed from accommodative to neutral. Neutral means that we can keep the repo rate unchanged, we can decrease the repo rate, or we can increase the repo rate. Neutral means any step can be taken. Okay? So this is the idea. So when was the stance reverted from accommodative to neutral? In the June 2025. Now, coming back, if the repo rate is being decreased or increased, how is it going to affect the interest rate in the economy? If the repo rate is being decreased, that is the lending rate at which the banks will get the loan from the RBI. So if repo rate is decreasing, the interest rate will decrease in the economy through the external benchmark linked lending rate. So RBI has stated, or basically since October 2019, all banks have had to link their retail floating rate loans. Floating rate loans are such loans whose interest rate can change in the economy. With the change in the economic conditions, market conditions, the interest rate can change on the periodic basis. So since October 2019, all banks, they had to link their retail floating rate loans and MSME floating rate loans whose interest rate can change on the periodic basis to an external benchmark. In case of most banks, they have kept repo rate as their external benchmark. So if the repo rate is decreasing, the interest rate has to be decreased for the retail loans, for the loans that are provided to people like you and me, and for the MSME loans. For the If the repo rate is increasing, the interest rate will increase. So this is the idea that uh, there is the external benchmark linked lending rate. So if the repo rate is changing, the interest rate will change in the economy. If the repo rate is decreasing, interest rate will decrease. At lower interest rate, more loans will be taken. More loans means more money in the hands of people, more demand. More demand means more production, more growth in the economy. Okay? So this is the idea. Now, easing cycle initiated in February 2025. So that we know that the repo rate was first decreased in February 2025, and till December 2025, there was the decrease in 125 basis point. So from February 2025 to December 2025, there was a decrease in the repo rate by 1.25%, that is 125 basis point. But if we see for the financial year 2025-26, that is from April 2025 till December 2025, there was the decrease in the repo rate by 100 basis point, that is 1%. Any confusion? So transmission of policy rate, that means if repo rate is changing, the interest rate will change in the economy. This is because of the external benchmark regime that was introduced in October 2019. Now, during the year, to ease potential liquidity stress, to see, CRR is the reserve rates, it is the cash reserve ratio. It is the cash reserve ratio, that is the reserves that the banks have to keep with the RBI. So if the banks, they are getting the deposits, from these deposits the bank can lend. But a part of the deposits the banks have to keep in the form of reserves, that is the CRR with the RBI in cash. Now, what is the CRR the banks have to keep? That is decided by RBI. RBI decided that the CRR will be reduced by 100 basis point, that is 1%. CRR will be reduced from 4% to 3%. So that if less reserves the bank have to maintain, the banks will have more money to lend, because the banks have to maintain less reserves, so bank will be left with more money to lend. So RBI said that to maintain or to provide more liquidity in the economy, so that the people have enough money in their hands, so that people can demand more. If people are demanding more, there will be more production, there will be more growth. So so RBI said that CRR will be reduced, so that the banks have to maintain less reserves and bank can lend out more. So less reserves, CRR was reduced 100 basis points, that is 1%. CRR was reduced from 4% to 3%. It did not happen immediately, it happened in a phased manner in 4 tranches from September to November 2025. This is the idea. Now, coming to the next point. Any confusion? So Reserve Bank reviewed the liquidity management framework. See, liquidity management framework, it was reviewed. Liquidity management framework basically says that repo rate is in the middle, SDF rate, this is the deposit rate at which RBI takes the deposit from the banks. So deposit rate is in the floor, and the MSF rate, this is the penal rate of interest at which the banks can take. This is the penal rate of interest at which the banks can take more loans from RBI. So if the repo rate, so in the middle you have the repo rate, in the floor you have the SDF rate, and in the ceiling you have the MSF rate. Yeah. So repo rate is 5.25% currently. SDF rate is always lower than the repo rate by 0.25%. So if repo rate is 5.25%, SDF rate will be 5%. MSF rate is always, because it is a penal rate of interest, it is higher interest rate at which the banks can take more loans. So the MSF rate is higher than the repo rate by 0.25%. So MSF rate is currently 5.50%. So what is the difference from lower to higher? It is 50 basis point. Okay, or 0.50%. So the Reserve Bank reviewed the liquidity management framework against the backdrop of structural changes, and after the review, it was decided that the policy corridor will be kept at 50 basis point only. The policy corridor with the repo rate in the middle, SDF, that is the deposit rate of RBI at the floor, and the MSF at the ceiling. The difference will be 50 basis points only, that is 0.25%, 0.25%. So in total 0.50% or 50 basis point. Okay, it was said that the RBI will retain. See, if the repo rate is changing, how the market will have the change in interest rate for the loans. There is uh, external benchmark, that is external benchmark linked rate for the loans, for the floating rate loans, retail, and for the MSME loans, it is fine. But the other interest rate, there is the weighted average call rate. Weighted average call rate, this is the overnight rate at which the banks borrow and lend. So it is said that if the repo rate is changing, the weighted average call rate should change in the same direction. This is the overnight rate for the this is the overnight weighted average rate for the banks to do the borrowing and lending between themselves. So interbank borrowing and lending rate for the overnight loans. Okay. So for the overnight, that is for 1 day loans between the banks, or the borrowing and lending between the banks. So weighted average call rate is the operating target for the monetary policy. So if the repo rate is increasing, the weighted average call rate should also change, so that the banks start recognizing that this is the new rate. If the repo rate is decreasing, the weighted average call rate should also change. Okay. 14-day variable rate repo and reverse repo auctions, they were considered as the primary auctions through which RBI can provide further liquidity in the market, or RBI can absorb the liquidity in the market on the immediate basis. Now, with the review, it was decided that instead of making the 14-day variable repo rate or the reverse repo rate auctions as the primary ones, now the primary variable repo rate auctions and the variable reverse repo rate auctions, the primary auctions will be the 7-day auctions, because they are for a shorter tenure and they will be able to impact the market on the more immediate basis, or in the more immediate uh, conditions. Okay. So this is the idea that other tenures, they also continue overnight. Variable repo rate also happen overnight, variable reverse repo rate also happens, and for other tenures also the auctions happen. But the 7-day will be the primary auction that will be conducted most. Okay. Before, 14-day was the most primary auction, but now it was said 7-day will be. Now these are the review that was done. I think the results were released in September 2025. Okay. So whatever decisions have been taken in the previous financial year, that is what we are discussing. So system liquidity improved as the CR, it was decided that the CRR will be reduced from 4% to 3%. So other initiatives were taken, as I've said, that auctions happen whenever the RBI wants to increase the liquidity or absorb the liquidity. The auctions can be done by the RBI. Okay? So system liquidity improved in 2025-26 with average daily surplus of 1.86 lakh crore. You don't have to remember the number. The idea is that RBI maintains the liquidity through the auctions also. Now, during the year absorption, during the year when the liquidity was more in surplus, see, RBI do not want too much liquidity in the market. RBI do not want deficit liquidity in the market. RBI do not want too much liquidity or very less liquidity in the market. Both is harmful. So if there is less liquidity, RBI injects the liquidity, provides the liquidity. If there is too much liquidity, RBI absorbs the liquidity. Absorption of the liquidity was done majorly through the standing deposit facility. This constituted 84.9% of average total absorption that happened through the adjustment facility. Okay. So major absorption, if there is surplus liquidity in the market, too much liquidity in the market, so RBI absorbed the liquidity majorly from through the SDF. That is what you have to remember, that in case of the previous financial year, when there was surplus liquidity in the market, RBI used SDF to absorb most of the liquidity from the market. Weighted average call rate, as I've talked to you, as I've told you, that the repo rate, whenever the repo rate is changing, the operating target is weighted average call rate. That if repo rate is changing, the WACR should also change. So weighted average call rate moved in line with the repo rate. That was good, because this is the target, that if the repo rate is changing, weighted average call rate should also change. Average 7 basis point, that is 0.07% below the policy repo rate. So whenever the change was coming in the repo rate, the weighted average call rate was also changing, but it was lower than the repo rate by 0.07%. That is a fine case. Okay? Any confusion? See, the auctions, RBI do the auctions to provide the liquidity in the economy, to inject the liquidity in the economy, or to absorb the liquidity in the economy. Before, the auctions were happening for the 14-day time period. That means the liquidity was provided for the coming 14 days, or the liquidity was absorbed for the coming 14 days. So auctions were happening for a 14-day time period. It was said that to provide liquidity on the immediate basis and to like have smoother short run operations, rather than 14 day, we should focus on the primary 7-day auctions. Okay, like I have taken a detailed session on this that you can see right now. This is what you have to understand here. The share of EBLR linked loans, the share of external benchmark linked loans in the total outstanding floating rate loans. So in the total loans that are provided at the floating rate, that are providing at the floating rate, so total loans that are provided at the floating rates, out of that, um, the private sector banks loans, they are mostly at the external benchmark linked rate. Okay, so it is the idea that the private sector banks, they are providing more loans at the external benchmark linked rate that are linked to the repo rate. So the private sector banks, they are able to have faster monetary policy transmission if the repo rate is increasing, or if the repo rate is changing, the EBLR, the interest rate also changes. That the private sector banks are able to change the interest rate. While for the public sector banks, they are providing loans, but only 50.6% of their loans are at EBLR. So the private sector banks, they are able to, in a faster manner, they are able to have the monetary policy transmission. Okay, so the share of EBLR linked loans in the total outstanding floating rate loans is higher for the private sector banks in comparison to the public sector banks. Now, weighted average lending rate. So the lending rate on the fresh rupee loans moderated. So as the repo rate decreased from 6.50% to 5.25%. So there was decrease in the repo rate. So the lending rate in the economy also decreased for the fresh rupee loans and for the older loans also. For the outstanding loans also, for the fresh rupee loans also, the lending rate decreased. The highest decline in the lending rate was for the fresh rupee loans for export credit, while on the outstanding loans that were on the floating rate. That's why on the outstanding loans, all the older loans also, the interest rate could decrease because they were on the floating rate. So the highest decline was in the trade segment. Okay. Now coming to the fourth chapter. So we have completed the third chapter. Now we are coming to the fourth chapter. Just one more chapter we will discuss. Okay. Any confusion? EBLR is the external benchmark linked rate. I have discussed it here. Here, what happens that the interest rate is linked to the external benchmark that is used by many banks as repo rate. So if the repo rate is changing, the interest rate by the banks will be changed. Okay. Now coming to the next chapter, that is the credit delivery and financial inclusion. So Reserve Bank continued with its efforts to strengthen credit delivery and deepen the financial inclusion in the country as envisaged under the National Strategy for Financial Inclusion. The Financial Inclusion Index improved from 64.2 in March 2024 to 67.0 to March 2025. Okay. So the financial inclusion index improved. That means there is higher financial inclusion that happened. Now the financial inclusion index was first published in August 2021 for the financial year ending March 2021. As the 5 years of the launch has been completed for the financial inclusion index, the financial inclusion index 5 year has been completed. So a comprehensive review of financial inclusion index has been conducted by the department on completion of 5 years of its launch. This is it. Now coming to the next point, do you remember that for the micro and small enterprises, the collateral free loan limit was increased from 10 lakh to what? For the micro and small enterprises, this we have discussed again and again. For the micro and small enterprises, the collateral free loans that are provided to the micro and small enterprises, its limit was increased from 10 lakh to 20 lakh. This is it. Next, in view of significant developments in the financial landscape and evolving need of the MSMEs, there was the additional decentralized outreach mechanism that was adopted through district level MSME Samvad meetings. So basically, district level MSME Samvad meetings, this is a new mechanism for the outreach that was developed. As on March 31st, 2026, this is important, 100% coverage has been achieved under the expanding and deepening of digital payment ecosystem. So under the expanding and deepening of digital payment ecosystem, under this program, 100% coverage has been achieved in more than 80% of the districts. So this is the idea. So 100% of coverage for expanding and deepening of digital payment ecosystem, this has been achieved in more than 80% of the districts. On a year-on-year basis, the outstanding credit to the MSMEs by the scheduled commercial bank increased by 23.5% as compared with lower percentage in the previous year. So there is more credit that is given to the MSME sector. That is good because they have higher need of the credit. Next is the priority sector lending. So scheduled commercial banks, the public sector banks, the private sector banks, the foreign banks, the small finance bank, and the scheduled commercial banks, like in total, they were able to achieve the target of 40% of the overall priority sector lending, and they have achieved more than 40%. So that is a good thing. So the scheduled commercial banks, they need to achieve 40% of the priority sector lending target. They have to provide 40% of their lending to the priority sectors: agriculture, MSMEs, renewable energy, um, social infrastructure, export, housing, and such. So scheduled commercial bank had the target of 40% and they achieved more than that. Okay, especially the private sector banks did even way higher percentage. Now, Kisan Credit Card, this is a single window facility for providing working capital as well as investment credit to farmers for cultivation. So, Kisan Credit Card, I hope you have heard this. This is the single window facility through which working capital as well as investment credit can be provided to the farmers for cultivation. But the operative Kisan credit cards have declined in the recent period, as well as the outstanding amount, the loan amount has also decreased by 4.9% during 2025-26. Now, financial inclusion, for that, nationwide campaign involving banks was conducted by Department of Financial Services, in which RBI also joined, and RBI said that the RBI will be focusing on expanding the coverage of re-KYC. KYC again. Okay? So Reserve Bank has been closely associated with the nationwide campaign involving banks conducted by Department of Financial Services, where the focus is given to saturate or to expand the financial inclusion schemes at the Gram Panchayat level. Now, the Reserve Bank in this particular nationwide campaigns, RBI focused on re-KYC. Okay? Now, the Reserve Bank was also involved in the nationwide campaign Aapki Poonji Aapka Adhikar. If you remember, I think in 2023 or 2024, there was a question about Miss Money and Mr. Money and such. So, the names are very important of the campaigns. Okay? So, Aapki Poonji Aapka Adhikar, this was the campaign by the Reserve Bank of India to focus on the unclaimed deposits and to facilitate the return of unclaimed deposits. Let's say you have unclaimed deposits. If they are unclaimed for more than 10 years, the deposits are sent to the Depositor Education and Awareness Fund. So, if you want to claim your deposits, such kind of campaigns were launched by the RBI so that the unclaimed deposits can be returned to the people. Okay? Now, comprehensive review of lead bank scheme. It was said that the RBI will be reviewing the lead bank scheme. Lead banks are basically the banks that are authorized to look after a particular district and to promote the banking services and to expand the banking services in that particular district. So the lead banks are the lead banks, basically they are the lead institutions to promote the banking services in a particular district, in a particular area. 12 public sector banks and 2 private sector banks, that is the Jammu and Kashmir Bank and ICICI Bank. So 12 public sector banks and 2 private sector banks, Jammu and Kashmir Bank and ICICI Bank, they have been assigned the lead bank responsibility covering 778 districts across the country. So here I have pointed out the most important points, the most important data points from where the questions can come. This is what you have to remember. Just read it once, you will be able to remember. Koi confusion? So KCC, the Kisan credit card, the number of the Kisan credit cards as well as the outstanding loan in that has decreased. The priority sector lending target for the scheduled commercial bank is 40%, and the banks have achieved more than 40%. So scheduled commercial bank have achieved more than 40%. That's it. Financial inclusion schemes, for the saturation, for the penetration of the financial inclusion schemes in the Gram Panchayat level, the Department of Financial Services have taken steps national campaign in which RBI joined for basically focusing on the re-KYC. Next is Aapki Poonji Aapka Adhikar. This is basically the campaign by the RBI or from the RBI for focusing on the unclaimed deposits. Okay? Next is lead bank responsibility, 12 public sector banks, 2 private sector banks. 2 private sector banks are the ICICI Bank and the Jammu and Kashmir Bank. Next is expanding and deepening of digital payment ecosystem. We have just discussed it previously that 100% coverage has been achieved in more than 80% districts. Now it has been said that the EDTP program was extended to all districts except two districts of Union Territory of Andaman and Nicobar Islands in August 2023. As on March 31st, 2026, 100% of the coverage has been achieved in more than 80% of districts across the country, which include all districts of 22 states and 8 union territories. They have been completely covered under the EDDP program. So that is the idea. Now, financial literacy. For financial literacy, the Financial Literacy Week was launched, and the Financial Literacy Week had the theme KYC, your first step to safe banking to promote awareness. Okay. So Financial Literacy Week that was conducted in February 2026 had the theme KYC, your first step to safe banking to promote awareness about the KYC. Next is Financial Inclusion Index. The Financial Inclusion Index, its value has increased from 64.2 to 67. So the inclusion index has improved, basically because of which parameters. So financial inclusion index has three parameters: usage, access, and quality. Usage has the weightage of 45%, access 35%, and quality has the weightage of 20%. So because of usage and quality, because of the usage and quality, because of these two parameters, all the parameters improved, but these two parameters improved largely. Okay. So usage and quality parameters, because of these two parameters, basically the financial inclusion index improved to 67 in March 2025. Now coming to the last part. So National Strategy for Financial Inclusion 2025-2030. So I hope you have already covered this. This was released in December 1st, 2025. If you have not, then just focus on these points that I have marked. So the National Strategy for Financial Inclusion, it focuses on upscaling the financial inclusion efforts towards seamless and effective access to a bouquet of formal financial services. When we talk about financial inclusion, the banking services, the investment services, pension services, insurance services, postal services, all of it comes under the financial inclusion. Okay? Under the National Strategy for Financial Inclusion, 5 strategic objectives were laid down, under which there were 47 action points that were to be achieved. The focus of the recommendations is on enhancing the usage and quality dimension of financial inclusion. So, the focus of the recommendations under the National Strategy for Financial Inclusion, the focus of the recommendation is on enhancing the usage and quality dimensions. The strategy has been framed under the aegis of the technical group on financial inclusion and financial literacy. So just read it once, but these are the most important points that I have highlighted. Okay, this is it. Done. Any confusion? Now coming to the next chapter for financial markets and foreign exchange management. Okay. So during 2025-26, the Reserve Bank continued its focus towards further strengthening of various segments. So basically, UTI, everyone remembers the UTI. This was in news in Feb 2026. This was in news in March 2026. This is anyone who remembers UTI? This is the unique transaction identifier. The unique transaction identifier, which is of 52 characters, and the starting 20 characters are the LEI characters and such. Unique transaction identifier were brought for OTC derivative transactions. Okay. So this is the idea. So Financial Markets Regulation Department, the directions were released for UTI for OTC, as well as this Financial Market Regulation Department. It also focused on linking the foreign exchange retail platform with the Bharat Connect, with the Bharat Bill Payment System platform. Okay, so that the people, like the individuals, they can get the easier access to the US dollars at the fair price, especially at the fair price. Okay, so the foreign exchange retail was linked with Bharat Connect in 2025, October 2025. In the first phase, the purchase of US dollars were allowed by the individuals through this platform, so that they can see the actual prices or the fair prices. Next, the investment regime governing investment by foreign portfolio investments. So it was said that the foreign portfolio investors, they can invest in the country in the corporate debt securities. There were the short-term investment limits and the concentration limits. Now they have been withdrawn. So for the foreign portfolio investors investment in the country, the short-term investment limit and the concentration limits, they were withdrawn. Surplus balances in the special rupee Vostro account. So let's say the Russian banks, they have the special rupee Vostro account with the Indian bank. So if the exporters of the Russia, they are exporting their products to India, they are exporting oil to India, and we are paying in rupees in the special rupee Vostro account. Now the Russian banks or the Russian people or the Russian entities, they can use these rupees that we are giving for their exports. They can use these rupees for the investment in central government securities, including the treasury bills. They can use these rupees for investment in non convertible debentures or bonds and commercial papers. So surplus balances in the special rupee Vostro account can be used to pay for the exports from India as well as to pay for the investment. Okay? To further enhance ease of doing business for the foreign portfolio investors and to give them the idea about the limits, it has been said that the VRR limits, and this we have discussed recently only, that the VRR limits, that is the voluntary retention route, through that whatever investment is coming, that limit will come under the general route limit. So general route limit, it is 6% for the central government bonds, central government securities, 2% for the state government securities, and 15% for the 15% for the corporate bonds. These same limits like the VRR voluntary retention route will come under these limits only. Next is to give the focus to the, or to give the push to the market for the financial for the municipal bonds. To give a push to the market for the municipal bonds, such bonds were notified as eligible collateral for the repo transactions in consultation with the government of India. So as you know that under the repo transaction, let's say the banks are taking loan and they have to provide a collateral. Now the municipal bonds, they will be allowed as collateral under the facility. Okay? Trading and guaranteed settlement facilities. Before it was said that the guaranteed settlement facility will only be provided for the foreign exchange forward contracts for 13 months. So if the forex forward contract is happening for a period of 13 months, up to 13 months, for that guaranteed settlement can be provided. But now this tenure has been increased up to 36 months. That means for 3 years. If you are doing a forex forward contract for a 3-year time period, then also your trading and guaranteed can be your trading and settlement guarantee can be there. Okay? Now, modified Mumbai interbank forward outright rate based swaps and foreign exchange options, they would enable electronification. That means if the swaps and the foreign exchange options are happening with this particular benchmark, that is modified Mumbai interbank MY4, basically MY4. So if the benchmark is MY4 for the swaps and for foreign exchange options, for such kind of derivatives, swaps and options, for such kind of derivatives that have the benchmark as MY4, as modified MY4, for that the transactions can happen on the electronic basis. Okay? So here UTI that we have recently discussed in March also. So this is what you have to remember. Foreign exchange retail was linked with Bharat Connect for particularly in the first phase for the US dollars transactions and for the fair price that can be provided to the individuals. For the FPI investments, there are certain relaxations were provided as the short-term investment limit and concentration limit were removed, and surplus balances in special rupee Vostro account can be invested in these particular securities. Remember it. VRR limits were removed, and it was said that the VRR will come under the limits of general route now. Eligible collateral. So municipal bonds have become eligible collateral for repo transactions, and before the guaranteed settlement was provided only for the foreign exchange forward contracts for a period of 13 months if they are the contracts for a period of 30 up to 13 months. But now the tenure up to 36 months, they also will get the trading and guaranteed settlement facility. And the modified MY4 for that derivatives, basically they would be allowed through the trading platforms, electronic trading platforms and such. Now coming to the next, based on the recommendation of the working group for the review. Now this was released last year, and last year we discussed this also, that the market timing for the call money, for the overnight borrowing and lending that happens between the banks. So the market timings for call money shall be extended to 7 p.m. The trading hours for market repo, tri-party repo. Tri-party repo is the repo operation that happens in which there is a third party that is taking the collateral, that is passing on the money and such. So for this, the revised trading hours shall be from 9 a.m. to 4 p.m. Basically, the under the Reserve Bank of India, the money market comes. Under the RBI, the money market comes. So for the money market, the trading hours were reviewed and it were updated as per the recommendations provided by the Sri Radha Shyam Ratho committee. Okay? So here the idea is that as per the internal working group, so based on the recommendations of the working group for the review of trading and settlement timings in the financial market regulated by RBI, Sri Radhashyam Ratho was the chairperson, and the committee suggested, or the working group suggested, the change in the timings. Okay, that was also accepted. Next is that SORR, the secured overnight rupee rate, it is accepted as the benchmark, and the FBIL, that is Financial Benchmarks of India Private Limited, will start publishing or has started publishing the benchmark, that is the secured overnight rupee rate, from July 2025. Okay. Now this benchmark, it depends upon the repo and tri-party repo rates. Next is FIMDA. FIMDA, that is Fixed Income Money Market and Derivatives Association. This has been granted recognition as the self-regulatory organization in the financial markets. Whatever I'm marking, that is something that you have to remember. So in this case, Sri Radhashyam Ratho was the one that was the chairperson of the working group, which recommended, or which notified the change in the timings. Okay. Next, SORR has been selected as a new benchmark that will depend upon the rates of the repo and tri-party repo, and this benchmark has started being released by the FBIL. Next is FIMDA has been selected as SRO in financial markets. FBIL, that is the Financial Benchmark of India Private Limited, it has been authorized to publish more reference rates, publish reference rate in the currencies of India's major trading partners. Okay, so FBIL will now be allowed to provide quote rates for larger set of currency pairs. Not very important. This particular is not very important, but the FBIL is important here. This is the authority that provides the benchmarks and the rates. Okay, this is recently we have discussed that for the open positions, for the net open positions in INR, it has been said that the authorized dealers for the net open position in INR, for the net open position in INR, that is, let's say the authorized dealer, they are buying 500 billion dollars or million dollars, and they are selling 400 million dollars. So $100 million they have, or let's say they are selling $300 million, so $200 million they have. So authorized dealer in one day, they cannot have more than $100 million left with them. That is what the net open position in INR. This is basically that the authorized dealers, they cannot have more than US dollars 100 million at the end of each business day. This is something that you have to remember, that authorized dealer, they are buying the dollars, they are selling the dollars, but in one day they cannot be left with more than $100 million at the end of the business day. If they have more, then they have to sell it within the business day. Next is Financial Markets Operations Department. The internal working group was constituted to review the liquidity management framework. We have discussed the review of the liquidity management framework, the 14-day to 7-day, the 50 basis point between the SDF and the MSF. So that was under the liquidity management that I said was reviewed, and the update revised liquidity management framework was released on September 30, 2025. So all of this is under the revised liquidity management framework. It is under the revised liquidity management framework. Okay. Yes. So basically, the internal working group was constituted under the Financial Markets Operations Department. Internal working group was constituted to review the liquidity management framework, which revised liquidity management framework was put in place September 30, 2025. Next is there is a lot of depreciation that is happening in the rupees. So which is the authority that intervenes to control the depreciation of rupees, or to control the volatility in the value of rupees? It is the Reserve Bank of India. Now, coming to the Foreign Exchange Department, Alankrit, I will suggest you that go to the start of the session, and in the start only you will see the annual report page or the cover page of the annual report. There you can see it is the annual report 2025-26. Okay, I hope this is clear. That go to the start of the session. There you will see the annual report cover page. In that also see the financial year. You will understand that why we are teaching 2025-26, because that is the report that has been released. Go to the start. So you will see the cover page that you can see. Okay, it is 25-26. Chalo. Now continuing foreign exchange department. Foreign exchange department. So comprehensive digitization initiative has been undertaken to consolidate. See, under the firm's platform, foreign investment reporting and management system, this is the platform that has been launched so that the foreign investment data can be consolidated here. Okay. Next is that merchanting traders to manage. So merchanting trade transaction. Merchanting trade transaction. Merchanting trade transaction, in which what happens, let's say Indian exporter or the Indian entity, it is buying mobile phones from Vietnam and selling these mobile phones to Dubai. So the mobile phones, they are not touching the Indian soil, they are not coming to India, they are just being, Indian entity is purchasing the mobile from Vietnam and just selling it in Dubai. So Indian entity is undertaking the commercial transactions in between, or is working as the intermediary to sell the mobile phones from Vietnam to Dubai. Okay, or Indian entity is the one that is purchasing the mobile phones from Vietnam and selling it in Dubai. So the mobiles are not touching the Indian soil, they are not coming to India. So these transactions are known as the merchanting trade transactions. ठीक है, इसमें ये बोला गया है, in this it has been said that the foreign exchange outlay, that is the transaction, the money should be, before it was that the transaction should be completed, especially the foreign exchange outlay, that is Indian entity has to pay to Vietnam, and it should get the money from Dubai within 4 months. Now it has been said that 6 month timeline is provided to the Indian entity to get the money from Dubai. Okay? So this is the idea that under the merchanting trade transaction, it was decided by the RBI to increase the time period for the outlay of foreign exchange to collect the money from the country within a period of 6 months. Before 4 months were provided. So let's say the mobile phones have been purchased from Singapore, they are being sold to Dubai by the Indian entity. So Indian entity has to pay to Singapore to get the mobile phones, and from Dubai it will get the money. So within 4 months, previously it was said within 4 months, the foreign exchange outlay, the foreign exchange transaction should be completed. But now it has been said that 6 months will be provided for the foreign exchange to be settled. To promote cross-border trade transactions, it has been said that entities, the Indian entities, they can provide. So authorized dealer banks, Indian entities, the authorized dealer banks, because they are the ones that are authorized to transact in the foreign exchange, to buy and sell the foreign exchange. So authorized dealer banks, they have been permitted to lend in INR to persons resident in Bhutan, Nepal and Sri Lanka. Only these three countries, remember this. Next is effective June 2025, importers have been allowed to make advance remittance for import. So importers of our country, let's say the importers, they want to purchase the shipping vessels. They want to purchase importers. They want to purchase the shipping vessel because they have the business in the transportation. So the importers, they want to import the shipping vessel. So up to $50 million can be paid in advance without any guarantee and such. Okay. So the Indian importers, they can pay $50 million in advance, up to $50 million in advance only, not more than that. If there is no guarantee and such, up to $50 million can be paid in advance. Next is instances of issuance of partly paid units. So basically, March 2024. So before March 2024, see what was happening, that the alternative investment funds, they are the funds that collect the money from the investors, from the sophisticated investors. So alternative investment funds, they are the privately pooled. They are the privately pooled funds. They collect the money from the sophisticated investors, and this money is invested. This money is invested in the different securities. Now, the foreign portfolio investors, they can also invest in the alternative investment fund. What was happening, that the alternative investment funds, they were allowing the partly paid units. That means the FPIs have given only 50% of the amount or 60% of the amount. Still, the units were allocated to the FPIs. 100% of units were allocated, or whatever the amount was, the units were allocated to the FPIs, even with the partly paid units. RBI said that instances where the issuance of partly paid units has happened. That means the FPIs have paid partly, but the units have been issued to them. In this case, if the person resident outside India. So instances of issuance of partly paid up units to person resident outside India. So if the AIF, they are providing partly paid up units to the person resident outside India. Now, this was not allowed before March 2024. Before March 2024, it was not allowed. Only in the March 2024, the directions were released that, okay, the partly paid up units will be allowed for the person resident outside India with certain rules and regulations. Now, RBI is saying that if you have provided partly paid up units before 2024, before March 2024, then okay, there is no problem. You will not be penalized in a big manner, but you have to you have to pay certain minimum penalties. You will be compounded. You have to pay certain minimum penalties. You will not have to close down, but you have to pay certain minimum penalties. Okay. Accordingly, it was clarified in May 2025 that investment vehicles, that is the alternative investment funds and such, they have to report pre-circular issuances. That is before March 2024, before the circular was released for the PPUs. Before that, whatever units have been provided by the AIF has to be informed within 180 days from the date of said clarification. Okay. And for the other general PPUs that are provided after the notification, that has to be reported on 30-day basis. So basically, before the March 2024, there was the release of the notification or the circular for the partly paid up units that were allowed to some extent with certain rules and regulations. Before March 2024, if certain investment vehicles, if they have provided partly paid units to the person resident outside India, it was said that these will be penalized. They will be compounded, like minimum penalty they have to pay, and they have to provide the clarification or reporting within 180 days of the date of clarification. After March 2024, if they have provided the PPUs, that will come under the directions and they will have to report within 30 days. This is the idea. Chalo. Now moving forward, through an amendment to foreign exchange management, foreign currency accounts by a person resident in India, basically it was said that let's say there is an exporter. It has received the money in the foreign currency account. So within 1 month of receiving the money in the foreign currency account, it has to bring back the money in India. Let's say the exporter in the US, in the foreign currency account, it has received $100 million. So it has to bring this money back within 1 month. But if the foreign currency account is in the IFSC, International Financial Service Center in India, that means the money is in India only, even if it is in the IFSC. So 3 months are provided for the money to be brought back to the domestic territory. Okay. So this is the idea that from October 2025, Indian exporters, if they have unutilized funds in their foreign currency account, they have to bring it back within 3 months if the amount is in the IFSC banks, or next month, by next month, that is within 1 month, from all the other jurisdictions. This is the idea. Next is Bharat Mart. I hope you remember, anyone remembers that Bharat Mart was opened where? UAE, US, UK, Singapore, Mauritius, where the Bharat Mart was opened. Last year, I think this was in news. So basically, Bharat Mart, it is the multi-modal logistics network-based marketplace. It was opened in UAE, where the Indian exporters, they can stockpile the products in the warehouses. Okay. So Bharat Mart, it is in UAE. So RBI has allowed exporters of India using Bharat Mart in the UAE to realize and repatriate export proceeds, that is to collect the export proceeds within 9 months from the date of sale of goods from the warehouse. So see, let's say Indian exporter is sending the products in the warehouse in the Bharat Mart, and the product is in the warehouse only. Let's say now the product is sold. So after the product has been sold, now within 9 months, money has to be collected and brought back in India. This has been said. So this is a relaxation that is provided. Otherwise, as soon as the product reaches to warehouse, after that only within 9 months, the money has to be brought back to India. But for the Bharat Mart specifically, because that is a Bharat Mart that has been opened in UAE, so it has been said that if the Indian exporter, they are putting their products in the warehouse in Bharat Mart in UAE, that has more connectivity with the other countries, and when the product is sold from the warehouse, after the sale happens, then 9 months, within 9 months, the money has to be brought back. That is within 9 months, the realization of the money should happen, the repatriation should happen to India. Okay. Next, coming to the last part, then this chapter will be finished. Okay. Now, to facilitate timely closure of entries, so export data processing and monitoring system is there, and the import data processing and monitoring system is there. Now, here the data processing happens, monitoring happens, and the documents are demanded from the exporters or from the importers and such. So, whole compliance, everything goes in through these systems. It has been said that if the export or import value is equivalent up to 10 lakh rupees, then there is no need to take multiple documents. Just on the basis of declaration, the processing can be finished. So to facilitate timely closure of entries in the export data processing and monitoring system and the import system, and to reduce the compliance burden on the exporters and the importers, authorized dealer banks, they were advised from October 2025 to reconcile and close the entries on the basis of the declarations if the value entries are only up to 10 lakh rupees. Okay. Next is repatriation. Do you remember that it was said that realization and repatriation of full export value should happen? So repatriation and the realization of the full export value should happen within 9 months. Now this timeline has been extended till what? This timeline has been extended till 15 months. Okay. So this is the idea. So in November 2025, the time period for realization and repatriation of full export value of goods, software services exported from India was extended from 9 months to 15 months. This is the idea. Okay. As well as time period for shipment of goods has been extended from 1 to 3 years from the date of receipt of advance payments. Let's say for your export, the advance payment from the export from India, from the India for the export, the advance payment has been done. So within 1 year of the advance payment, the goods had to be exported. Now the timeline has been extended to 3 years. So the time period for shipment of goods has been extended from 1 year to 3 year after getting the advance payment, as well as for the repatriation, realization and repatriation to get the money for your exports. Before 9 months were provided, now 15 months are provided. Next is that from Nepal and Bhutan, let's say some Indian is going to Nepal or Bhutan, they can take the 100 rupee note up to the limit of 25,000. If someone is coming from Nepal or Bhutan to India, they can also from their country, they can bring the 100 rupee note up to the total limit of 25,000. Okay. So this is the idea. Now, local currency, we want our local currency to be used for the transactions between the countries. If we are trading with the other countries, we want our local currency to be used. So local currency arrangement have been entered into with 4 jurisdictions: UAE, Indonesia, Maldives and Mauritius. And there is the special rupee Vostro accounts that have been opened by correspondent banks in 35 partner countries. Okay. So through the special rupee Vostro account, the trade settlements can happen in rupees. That is the idea. So now we have completed monetary policy operations part 1, and in the part 2, monetary policy operation, credit delivery and financial inclusion, financial market and foreign exchange management, uh, I and regulation and supervision and financial stability. This okay, not sorry. This we will discuss in next session. Now the last that we have to discuss is this chapter. So these 6 chapters out of 12 chapters, we have completed 5 chapters and 1 chapter is more. This is what we are going to discuss right now, just 5 more minutes, and the rest of the 6 chapters, which will not take much time, like 30 minutes will be required, or maximum 1 hour will be required for these 6 chapters. Okay, so this we will discuss in the next session with the MCQs. Now, the last thing that we have to discuss, the last chapter that we'll be discussing in this session is this. So, Reserve Bank's balance sheet. Now, why we are discussing this chapter? Because already in the central board, like we have discussed this, that the central board meeting happened, and under the meeting there were the information that was providing about the surplus transfer, about the contingent risk buffer. So in that we have recently discussed, the central board meeting, in that only there is the addition that is in this chapter. Okay. So recently the central board meeting happened of the Reserve Bank of India. The central board of directors meeting of Reserve Bank of India happened, and in that it was informed that what will be the surplus transfer that will happen to the government of India from the Reserve Bank of India. So this we have discussed in the Finance 360-degree session. Now, in addition to that, the more details are provided in these Reserve Bank's account for 2025-26. Just give me 5 minutes more. So Reserve Bank's balance sheet size increased by 20.6%. Okay.
as on March 31st, 2026. The income for the year, the income of RBI increased by 26.4% and the expenditure increased by 102.4%. Still, even if the income increased by 26.4% and the expenditure increased by 102.4%, still the surplus was left. Even after keeping even after the higher percentage increase in the expenditure, the surplus was left with the RBI, that RBI transferred to the government of India. Okay? So the year ended with an overall surplus of 2,86,588.46 crore that was transferred to the government of India. Okay? So the balance sheet size increased by 20.6 percentage. The numbers are not very important. Remember that the balance sheet size has increased by to 20.6% as on March 31st, 2026, and this is the new balance sheet size, that is 91 lakh crores. Next is increase in asset size. Now, again, percentages are not very important here. What you have to remember is the asset and the liabilities. The increase in assets. So for the balance sheet, the increase in assets was due to rise in domestic investment, gold, foreign investments. Okay. On the liability side, the revaluation accounts. So on the liability side, the revaluation account, notes issued, deposits, and other liabilities were there. Okay. Now, domestic assets constituted 29.1%, and the foreign currency asset, gold, loans, and advances to the financial institutions outside India, that is foreign investment or foreign lending, constituted 70.9% of the assets this year. So for 2025-26, this was the idea that domestic assets were 29.1% and the foreign assets, as foreign currency assets as well as loan advances outside India, were 70.9%. And increase on asset size, the increase on asset side was due to rise in domestic investment, gold, and foreign investment. Increase on liability side was because of revaluation account, notes issued. For notes issued, that was also a liability, deposits, and other liabilities. Okay, this is the idea. And in the asset size, the the most im- highest increase was on accounts of the gold on the asset size, while on the liability side, the revaluation account was the highest increase in the liability. Chalo. Next, coming to the RBI was constituted as a private shareholders bank in 1935 with an initial paid up capital of 5 crore. 5 crore with the initial paid up capital of 5 crore. So this is the capital fund. This is the capital fund. So RBI was constituted as a private shareholders bank in 1935 with an initial paid up capital of 5 crore. RBI was nationalized with effect from January 1, 1949, and its entire ownership remains vested with the government of India. The paid up capital continues to be 5 crore. The reserve fund is 6,500 crore. It was 5 crore first. Then there was the increase of 6,495 crore. So now it is 6,500 crore. That is the reserve fund. Now coming to the income. So you can see the income has increased by 26.4%. So the income has increased by 26.4%, while the expenditure has increased by 102.4%. Okay, by 102.4%. But still you can see that the income is higher than the expenditure, even if the growth in income is only 26.4% and the growth in expenditure is 102.4%. But still, even if the income growth is lesser than the expenditure growth, in absolute numbers you can see that the income is higher than the expenditure, and that's why the surplus was left, and surplus was 2,86,592, out of which 4 crores were given as the contribution to different funds. And so the surplus transfer from the RBI to the government of India was 2,86,588 crore. This was the surplus transfer from RBI to government of India. Now there are different funds. These two funds are of the RBI, that is maintained, while the other two funds are maintained with the NABARD, maintained by the NABARD. Okay. So the National Industrial Credit, now this fund was created in July 1964. You don't have to remember that when it was created. Just the idea is that the RBI made annual contribution. So initially the fund had the corpus of 10 crore. RBI made annual contribution of 1 crore on the annual basis. Here you can see annual contribution is 1 crore. So right now its corpus is 35 crores. Similarly, National Housing Credit Long Term Operations Fund, this this basic fund, it had the initial corpus of 50 crore. Now every year RBI is contributing 1 crore. So currently its corpus, the balance in the fund is 209 crore. 209 crore now. Okay? And the fund was set up in January 1989 for extended financial accommodation to National Housing Bank. So this is the idea. So industrial credit, its initial corpus was 10 crore, and every year the contribution by RBI is 1 crore. So currently its corpus is 35 crore. National Housing Credit, its initial corpus was 50 crore. Every year the RBI is contributing 1 crore. Its current corpus or its current fund is 209 crore. National Rural Credit and Rural Credit, this is under the NABARD. This is under the NABARD, and every year the RBI contributes 1 crore. Next, ECF, that is Economic Capital Formation. Sorry, the ECF facility, that is Economic. I'm not able to remember the form now. Economic Contribution Fund. What was it? Anyone remembers the full form? I don't know how I forgot this. Anyone remembers? Economic Capital Framework. Sorry for that. So economic capital framework. Okay. Economic capital framework, this was the framework that was recommended by the Bimal Jalan Committee. And under the economic capital framework, see what happens, Bimal Jalan Committee, it recommended the economic capital framework, which was reviewed last year. And it was said that under the economic capital framework, the contingency risk buffers have to be maintained by the RBI, because RBI is having the credit risk. RBI is providing the loan, so it has credit risk. It has the RBI is the one that is the monetary authority, so there is also the monetary and financial stability risk that RBI has to handle. The monetary and financial stability risk, RBI also has to handle the operational risk. So against the so many of the risk, RBI needs to have the contingent risk buffers. RBI needs to have the buffers. So whatever its income, from the income, RBI needs to maintain the contingent risk buffer. Okay. So contingent risk buffer can be 4.5% of the balance sheet till 7.5% of the balance sheet. So the contingent risk buffer should be within the range of 4.5% to 7.5% of the balance sheet. So under the economic capital framework, it was said that the contingent risk buffers have to be maintained by the RBI, and after that, whatever is left can be provided as surplus to the government of India. Okay. So now the RBI has decided for 2025-26 to maintain the contingent risk buffer as 6.5% of the balance sheet. So that's why ECF, Economic Capital Framework, requires contingent risk buffer to be maintained within the range of 4.5% to 7.5%. Okay. The RBI decided to maintain the contingent risk buffer as 6.5% of the balance sheet for 2025-26. Accordingly, a provision of 1,09,379 crores, it was transferred. Okay, in the contingency fund. So a provision of 1,09,000 crores was made and transferred to contingency fund to maintain the contingent risk buffer at 6.5% of the balance sheet. Any confusion? So this is the end. So we have discussed the part one, the two chapters, then third, fourth, fifth chapter we have discussed, and the last 12th chapter we have discussed. The in middle, the six chapters, they will not take much time, but we will discuss it on Tuesday. And we will also, not only this, I'm also thinking to bring the MCQs. So do you want the MCQs in that session itself? Because that session will not be very long. I will try to like finish it in like 40-50 minutes. So do you want the MCQs also? Any confusion? Through MCQs, like, you have to practice. Contingent fund is basically the fund from which the money can be used to maintain or to handle the risk. Okay? So it has been said that the contingent risk buffer, the buffers have to be maintained for the risk. Now, the buffers that are maintained for the risk is under the different funds. So contingency fund is one of them, through which the money can be taken out in the time of risk. So if there is the credit risk, if there is the monetary and financial stability risk, if there is the operational risk. Okay. So there is contingency fund. In this, the money is maintained, as well as there is also the as a development fund in which the money is maintained so that the money can be used during the time of risk. And the contingent risk buffers are basically the buffers that the RBI has to maintain. So contingent risk buffer is the buffer that the RBI has to maintain as a percentage of balance sheet. The money for these buffers, the money is maintained in the contingency fund, in the asset development funds, and the other funds. Okay, so that is the idea. ये वाली annotated PDF नहीं मिलेगी because this is the session in YouTube. For the LPS students, the session of the annual report will be on 5th of June for your course. But in that, we will directly discuss the MCQs. Okay? So you can go through the PDF. Okay? You can go through the like you can go through the session, like for the course students also they have to go through this YouTube session and Tuesday one also. But for them, like for the course students, there will be a MCQ session, like 50 to 100 MCQs will be discussed in that MCQ session, through which through the MCQs again the whole report will be discussed but in a faster manner. Chalo. Yes, this PPT will be provided to you in the course also. Tuesday, most like I'm still working on the rest of the part, so most probably in the evening only in Tuesday, or afternoon. Like I will update the time tomorrow. You will get to know. Okay? Any confusion, anyone? How was the session? Any confusion, anyone? Contingent risk buffer is within the range of 4.5% to 7.5%. These are the buffers that the RBI has to maintain against its balance sheet as a percentage of its balance sheet. And these buffers, like for the handling of the risk, these buffers are the money is kept in the contingency fund, asset development fund, so that the money can be used during the time of the risk. Okay? चलो ठीक है. So on Tuesday, do tell me that do you want the MCQs in the Tuesday session itself? चलो, I will bring the MCQs for you also. Do not worry. This is it for today. Thank you everyone. Thank you for joining. If there is any confusion, you can ask me in the comment section below. And there will be a there will be a session on Tuesday. So if there is any confusion, we can discuss it on Tuesday also. So this is it. Thank you everyone. Thank you for joining.